which are in fact political, one could argue, by donating money to certain propositions in California when I was growing up there. Doesn't this make it a slippery slope?
Well, I mean, we don't have to speculate. We do know that under consideration was making climate change-related organizations no longer tax exempt. I believe reporting from my colleagues has shown there's pushback within conservative circles that they worry that another administration will come in and defund or rather take away the tax-exempt status of conservative organizations. So there is that precedent setting. You know, once you go in and start doing that on one side, it could come back to haunt you. I don't know the exact status of the climate change discussions, but that's one that's been under, investigation, certainly pressuring climate change-related organizations. But of course, all these things do have slippery slopes. But again, I just come back to the point that if you want to do it legally, Congress really, up until violating the Constitution or people's First Amendment rights, Congress has much greater ability to actually make these things stick than the stroke of a pen.
All right, so appreciate it, Eric, covering all of it. Certainly the bill making its way through Congress, and of course, the latest on what we are hearing about the government in terms of Harvard and international students. Our Eric Wasson, Bloomberg News congressional reporter up there on Capitol Hill. We should point out at Harvard, almost 6,800 students, or 27% of the entire student body, come from other countries. That's up from 19.6% in 2006, according to the university's data. All right. Watching that story, also continue to watch what's going on in the U.S. Treasury market, coming off of what Eric talked about in terms of the president's massive spending and tax bill. We know Treasury investors have been watching it so closely, Tim, and in particular, the composition and what it means for the U.S. federal deficit. We got with us Ira Jersey, Bloomberg Intelligence Chief U.S. Interest Rate Strategist. He joins us from Bloomberg Intelligence headquarters in Princeton, New Jersey. Certainly calmer today, Ira. Would you go as far as to say we saw an appearance by the bond vigilantes yesterday?
Yeah, so we definitely, I wouldn't say that it was calmer today. You know, we sold off pretty dramatically in the morning, and then we've come back here a bit in the afternoon. Yeah, I think there are people who are worried about the deficit and the fiscal situation of the United States. And because of that, you certainly have some people who are either avoiding U.S. debt or maybe even incrementally selling it. The issue with continually, being short the market is that it's a negative carry trade. So it's hard to stay in it for a long time because you're always paying something and you have to have a capital return in order to kind of stick in that position for a very long period of time. So what happens is you get these big moves and then you get a consolidation for a while until you get the next headline that really pushes the market one way or the other. This bill, like certainly yesterday's market move in large part was because people are worried that there's going to be more debt outstanding versus the amount of demand that there might be for treasuries. I mean, what are you thinking? Is it another leg up at some point whenever we get that catalyst, or could it be a leg down? That's kind of the environment that we have been in, it feels like, for a long time, but I'm just curious how you see it. Well, I'm assuming you're talking about Treasury yields, yes, because let's stay in the same space, yes, right? Yes, we don't want to have the yield price confusion. But I actually suspect that we're nearing the yield high, at least temporarily, where everyone's been saying, oh, these are the highest yields since 2007. That's not correct. 2023 was the last time we were at these levels where 5.17% on the 30-year bond was the high. So we haven't broken that yet. We were just retesting the yield highs. Look, when you look at the whole yield curve from the 2-year note all the way out to the 30-year bond is only about 1.05%, right? 105 basis points. On a historical basis, you go back to the mid-2000s, you go back to the 1990s when I started in the business, and the yield curves used to be significantly steeper than that, right? Hundreds of basis points steep. And so this is not an unusual shape of the yield curve. I think the fact that we've had this bear steepening because of the fiscal fears and the idea that we might have additional inflation because of tariffs is really driving a lot of the repricing of the curve over the last couple of weeks. I think ultimately the curve will steepen even more, but it'll be the other way. 30 years, 10 years, they don't do a whole lot of anything, and you wind up seeing 2-year yields go down as we price potentially for a recession and the Federal Reserve cutting interest rates. And I think that that's probably the next big move in the market. I'm not saying it's necessarily going to happen in the next week or two, but I'm saying over the next quarter or two I think that's probably the next big market move.
So what's your view on rate cuts this year, given what you just said about recession probability or recession odds, Ira?
Yeah, I think they're about right now. So we had thought all along that pricing for June or July rate cuts was far too early because we won't have enough information and data for the Federal Reserve to feel comfortable cutting rates. September's not impossible, but we had kind of penciled in November, December this year, and then more cuts next year. I think what's happened though in the market is it's pricing the beginning of rate cuts properly, but the market's missing that I think the Fed's going to cut even further than what the market's currently priced. So the market's only priced for about 4 rate cuts. I think the Fed's more likely to do 6 or 7, and we haven't priced those in. So I think 2026 cuts are mispriced right now, but 2025 cuts are probably close to fair value.
You know what I find, Ira, fascinating about this environment is that, things like Fed meetings or earnings or, I don't know, things that normally job reports would consume us. I'm not saying aren't important, but would consume us, has been overshadowed by everything coming out of the White House. We did get some economic news today. We got reads on manufacturing, PMI services. They came in strong or better than forecast. So the economy continuing to hold up.
Yeah, so the economy is good now, and that's the reason why I think that, and have thought for a while, that the Fed wouldn't cut early, because we're not going to see the effects of everything. The problem is we're in this YouTube short world now where everyone wants everything to happen in the next 5 minutes. That's not the way the real world works, right? Everything that's being implemented now, whether it's tariffs or immigration reform and everything else, all of those things are going to take another 6 months to a year to kind of start to see the real effects of that on the economy. And once we do, that's when the Fed will react and we'll have better information. So, look, we've really only been having these discussions for the last 6 weeks.
Yeah.
It's not, and many of them aren't implemented, right? The 90-day moratorium and all
Correct.
of those things are just pushing things down the road. So until we get to the end state, we can't really analyze what's the final outcome. Now, we have a forecast and a guess, right? But at the same time, that can change dramatically depending on what the fiscal situation is. But to your point, Carol, the fact is that all of the news coming out of the White House and the economic folks there, that will have longer term effects, and that's a reason why the markets keep reacting to that, because we have to guess what the final end state is.
Fab. Thank you so much, Ira. So appreciate it. Of course, Bloomberg Intelligence Chief U.S. Interest Rate Strategist Ira Jersey out there at our BI headquarters in New Jersey. We're going to stay on rates. We're going to broaden out a little bit to global rates, because what we have seen from U.S. to Japan, long-term borrowing costs for the world's biggest economies are surging as investors are basically questioning the ability of governments to cover those massive budget deficits. I mean, Tim, there's a narrative here.
There is. The Bloomberg Opinion columnist John Authers writes that the bond vigilantes may need a lot of rope. Check out John's column on the Bloomberg terminal and at bloomberg.com/opinion. John joins us from New York City right now. So the move up in rates, not just a U.S. thing, John.
No, I think that's quite important to note. You can't pile this all on the big, beautiful bill, although that's obviously a problem in the States. You've actually got, in Japan, the 30-year yield is actually at its highest ever. And that's a country that until very recently was very, very directly intervening to keep bond yields down. So it looks as though regulators may be losing control over that. And back home in the UK, there was an unpleasant surprise from inflation yesterday. The inflation really is rising again in Britain, and that led to the highest 30-year yields since, I think, something like 2007. They've actually surpassed where they were during the Liz Truss incident, which seemed to be a gilt's meltdown for the ages when it happened. So it's not just a US phenomenon, and it's not just, I don't think, about fiscal deficits, although that's obviously a central part of it. I think while you're worried about trade, then and the risks of higher tariffs, then that implies concerns about growth and about inflation. And if you're worried about inflation, you're less likely to buy bonds. And then there is the big demographic issue that people are getting older. That in many of the major countries, the proportion of those who are retired is going to be much higher than those who are still working over the the next decade or two. And that will mean that there will be less buying of bonds at the margin, and that will probably mean that the yields go up. We've had this demographic sweet spot that allowed this great bull market to carry on for decades when the yield seemed only ever to go down. The risk is not so much that there will be bond vigilantes desperately calling a halt to the borrowing now.
Yeah.
But very steadily, the ratchet effect works on governments and limits what they can do.
So, John, so net conclusion, if this is what's going on around the world, what kind of global macro environment does this essentially create? I mean, are we talking global slowdown, global recession, a very different environment that investors and citizens have been used to maybe over the last decade or so? Just to wrap up.
I think it basically means a slowdown. It means a much more stodgy version of capitalism than the one we all got used to while globalization was running riot and people were and countries were successfully keeping interest rates very low. If you've had inflation come back, and if you're now having pressure on trade plus the demographic factors, that sweet spot basically is over, and that will be, if capital is more expensive, if money is more expensive, then the economy is probably going to be slower. Yes.
Yeah.
Not just in the US.
No, and I think it's really, we kind of agreed when we were putting together our show this morning that we got to talk about the global, what we are seeing in terms of global rates and the impact that all has. Glad we could get some time with you. John Authers, he's Bloomberg Opinion columnist. John Authers, and you can find his column and other columns by our Bloomberg Opinion team. Just check out the Bloomberg Terminal or check it out at Bloomberg.com.
Well, let's talk a little bit about today's big take, Carol Massar. I couldn't get enough of this, and the illustrations that are included in it. Max Abelson joins us now. He's Bloomberg News finance reporter. Whether it's geopolitics, trades, tariffs, or on more personal level, real estate, crypto, corporate ventures, some say the second term of President Donald Trump is all about the art of the deal. Some of the actions, though, have raised ethical questions that have been addressed by White House Press Secretary Caroline Leavitt, including earlier this month.
The president is abiding by all conflict of interest laws. The president has been incredibly transparent with his own personal financial obligations throughout the years. The president is a successful businessman, and I think, frankly, it's one of the many reasons that people reelected him back to this office. Look, I can assure you the president acts with only the interests of the American public in mind, putting our country first and doing what's best for our country, full stop. That's his intention, and that's what he's focused on.
Well, today, the Bloomberg Big Take is focused on how, since the early days of the re-election campaign, President Trump has more than doubled his net worth, Carol, to about $5.4 billion. All
right, we want to get into this. And with us, who has written this Bloomberg Big Take, it is one of the most read, and it is a must-read. It has been deemed so by our Bloomberg editorial team. Max Abelson and Andy Massa wrote the story. And joining us right now is Bloomberg News finance reporter Max Abelson right here in studio. It's pretty incredible because you guys have really laid out all that's been going on in terms of business activity for the president. We should just, we just heard from Caroline Leavitt, who has been asked about this at some of the press conferences, the daily White House press conferences, and she says the president abiding by all conflict of interest of laws, incredibly transparent, and so on and so forth. But it does beg a lot of questions. Tell us about how you approach this, because there's been a lot of stuff going on.
I would love to. I'm going to say something about our project, and I'm going to say something like that's basically the opposite of it. But you'll see what I mean. Our project is really about being able to step back and to say in concrete terms, factual terms, clear terms, what is happening here when a president is doing more than anyone in modern American history that we can tell, any other president in modern America, to position his family to make an astounding amount of money while in the White House. And when I say astounding, what we're talking about is not in the millions or in the hundreds of millions. What we're talking about is deals that are in the billions, whether we're talking about the Trump name powering, I think, more than $10 billion worth of real estate projects. The Trump name powering billions of dollars of value for his social media company, which only went public last year.
Right.
Hundreds of millions of dollars of crypto. And then I told you I was going to say something that was the opposite of this. This is what I want to say. As I was walking here from my desk in the newsroom, just on the other side of this floor to our radio studio, I saw that the United States government, the Trump administration, told Harvard University that it can't enroll international students, and that existing foreign students are going to have to transfer or lose their legal status. And for me personally, news like that, which I find comes basically every week, maybe sometimes every day, just these really things that I had never contemplated or never heard of, that there has been so much tumult in the last few months, so many things going on, tariffs alone, the stock market alone, the economy alone, that it is so easy to forget that what is happening on the Trump business side is really important too. So what Annie and I were trying to do, we're to try to just forget about politics and forget about policy, forget about things like Harvard, and just really focus on the Trump money-making machine.
Can I say there are folks that come in and say, we're all kind of chasing the stuff that is coming out of the White House, and the question often arises of like, well, wait, what are we missing? What is going on that maybe isn't in the headline or what the administration is talking about or the president and his team? So take it away, because you guys did some really deep reporting.
That is what we tried to do. So Annie Massa and I, with help from many editors, I want to mention David Shear, who really made this happen. What we tried to focus on is that compared to all that tumult that I just mentioned, all the Harvard news and the comings and goings, compared to that, there's something very clear about the Trump empire, which is that its approach and our timeline is since the re-election campaign began. Everything that we're talking about here is after he announced his re-election. The approach is clear. The Trumps are selling that family name, and they're doing it at a scale that I really do think could very well be the story of the day, the story of the year, if it weren't for all these things happening. We see the Trumps going and doing things they simply did not do in the last term, when they said no new foreign deals in the first administration. We were not talking about new foreign deals in the last administration, really, because Trump essentially said that they wouldn't happen. Now, you basically have to take out your globe, because Annie and I traveled, journalistically speaking, to Qatar, India, Vietnam, the United Arab Emirates. The United States is involved too. And at each point, they're doing really interesting things. They're licensing their name to really big projects, hundreds of millions of dollars, if not billions of dollars worth of projects. And sometimes, not all the time, but sometimes something very important is happening, which is that the deal includes arms of governments. I'm talking about, it may not be the Trump administration, it may not be the Trump family, I should say, signing a deal with a government, but governments are involved. And that rubs up against what Trump said would not happen this term, when Trump said there would not be new deals with foreign governments.
Governments involved, government money involved.
What we're really talking about is things like, let's say in Oman, for example. They announced, when they announced that deal, they announced as a partner the Omran Group, and that is essentially think of it as a state-owned tourism group, and they're going to be involved in that deal. Listen, let me point out that the Vietnamese, I believe he's the prime minister, he may be the president, but the one extremely important figure in Vietnam, met with basically the financial representative on the new Trump project in Vietnam. That is what we mean when we say that these things are very big, they're potentially very lucrative, and a lot are happening right now.
Max, real estate is just one piece of the puzzle here. It's certainly a global piece of the puzzle. The crypto story is included in here as well. You talk about World Liberty Financial, the Trump and Melania meme coins as well. I want to focus a little bit on the corporate side of things.
Yes.
I think that gets a lot less attention than everything else.
Right on.
There was a lot in here that I had never even heard of when it came to Trump family connections. Grab a gun, for example. Talk a little bit about the corporate connections and what you, Annie, and the team uncovered here.
I really admire Annie Massa's ability to put her finger on these corporate connections at things that I hadn't heard of. I mean, I think it's actually helpful to put crypto off to the side, because it gets so much attention. I mean, literally tonight, Trump is scheduled to meet with the top holders of one of his crypto projects. I think it's the meme coin. But then, so that gets all the attention. But then you see something like 1789 Capital. Donald Trump Jr. joined, I think he became a partner at 1789, like a matter of days after the election. I think it was less than a week after the election. And that's a group that, you know, Rebecca Mercer, if you remember the Mercer name, that is a really important Republican mega donor. And what they're basically doing, the way to think about it, is they're essentially monetizing the kind of Trumpian vision for U.S. culture by taking stakes in, you know, things like the enhanced games. I don't know if you've heard of that. Basically, it's been nicknamed the steroid Olympics.
Yeah, I've heard of these.
You know,
you can athletes who can sort of, they're not drug tested. You can do whatever you want, and then
that's right. That's right. Listeners,
that's my interpretation.
Listeners can't really see me right now, but I'm like extremely jacked and steroidal. You know,
yeah,
I'm an enormous person.
Planning to.
That's exactly. I'm going to fight in the steroid Olympics. That's right. You know, but the list goes on and on. There, it's almost too much to mention on just one interview. I want to give a shout out to Unusual Machines, which is essentially a drone component maker. You know, when this is how powerful the Trump name is. When Donald Trump Jr.'s role was announced by the way, in November 2024, right again on the money, the stock popped. Basically 250%, maybe just shy of 250% in like the 2 trading days that followed. That is power. I tell people that my beat here is money and power. That is money and power. And it keeps going. Have you ever heard of PSQ Holdings? Do you know Public Square?
Now I have.
Yeah.
This is the anti-woke,
Yep.
This is the anti-woke marketplace where you can go and buy
Yes.
items such as these pro-life diapers that you guys highlight in the piece.
Yep, I want to thank Michael Seifert, the CEO, who gave us a comment. He said that Trump Jr. is an incredible businessman, strategic partner, and marketing expert. And in other words, what he's saying is that we want Trump Jr. for his mind, not necessarily for anything else. But that's a good example of, like, you know what, $3 million more. That was Trump Jr.'s 2024 compensation we found for PSQ, and his board role was announced once again December of 2024. It keeps on going. There's Dominari, which listeners should read Annie Mass's separate story on Dominari.
We talked with Annie about it.
Super fascinating.
Yeah.
Have do you know the idea of, like, basically events contracts?
Yeah, we interviewed the Kalshi founders when
Yeah.
they launched years ago.
Kalshi, I mean, that role was announced January, and that's Donald Trump Jr. again. Eric Trump, I don't want to overshadow Eric Trump. Eric Trump is also involved in some of these stuff, but when you're talking about grab a gun, for example, that's yet again Donald Trump Jr. It's yet again. It's essentially the last few weeks. Yeah. It's yet again at least $3 million, and it's. You know, for listeners who, I think that I'm especially interested in talking to listeners who sort of, their minds aren't made up. You know, I don't think there's much to do as a journalist for readers and listeners who just know that they despise Donald Trump or that they know that they adore Donald Trump. I'm interested not in pandering to, like, this, someone who has their mind made up already. I'm really interested in just, like, focusing on the numbers and focusing on just, like, what's actually happening. And, you know, whether or not you dislike this or admire it, I think it's really helpful to take a step back and to look at a family empire that is poised to make money while the father is in the White House in a way that's, you know, I don't know what to compare it to. Obviously the Biden family, the Obama family, the Clinton family, the Bushes, I can add. All of these people are capitalists. You know, all of these families, we're familiar with the reporting around their money making for sure. But as a financial reporter, I've never seen, I think the key word here is the scale. Billions of dollars just for Trump Media and Technology Group, which you know of because it's the True Social parent.
Correct.
That went public last year. He was on the campaign trail. The scale is what appeals to me as a finance reporter because it feels so new.
Listen, to be fair, right? Like you say, other presidents and their families make money, whether it's they write books, they are consultants. There's a lot of things.
Speeches.
And just by being associated with a family that was in the White House, right? It definitely opens doors. But the point is, I think also, is so much of this is happening before going into the White House and now that he's in the White House.
That's a really good way of saying it. You know, one of my favorite early scoops, I think it was like in the first 5 years that I was at Bloomberg, was about Barack Obama getting paid, I believe my memory is hundreds of thousands of dollars, maybe 300,000, maybe 400,000, maybe it was less, for speeches at finance firms, including Cantor Fitzgerald, which is ironic. Cantor Fitzgerald is just across the street from us here in our Bloomberg headquarters.
Yeah.
Cantor Fitzgerald, of course, is the family that's in control, is the Lutnick family. Howard Lutnick, of course, is our Commerce Secretary now. And I bring that up. It's relatively random and relatively stale, but I bring that up first of all, because it goes to show that the Obamas, just like many other political figures, are interested in money making. But I just want to bring up the difference in scale. That as far as my reporting showed, that was a guy making a few $100,000. I know that his book deal, he made, what was that, like $60 million?
I think he made a lot, yeah.
But what I really tried to wrap my mind around, and I know Annie felt this way too, is that what we're talking about now for the family since the re-election campaign began, is in the billions.
Max Abelson, this is a great story. It's today's big take. It's one of the most read stories on the Bloomberg terminal. You got to read it online, because the illustrations in there are perfect as well. Max, thanks so much for joining us. Let's get on over to Charlie Pellet for an update on everything happening in the markets as we're about 90 minutes from the close. Hey, Charlie.
Well, hello there, Tim. A lot going on with the Dow, the S&P, NASDAQ, all advancing right now. But your key takeaway at this are, let's call it a cautious comeback after a Treasury sell-off, with stocks halting a slide amid a rebound in bonds and the dollar rising. So here's where we stand. S&P up 23 now, 58.68. Has been a choppy session. We're up 0.4%. The Dow matching that, also up 0.4%, up 170. NASDAQ Composite Index up 153, up 0.8%. NASDAQ 100 Index up 0.7%. Should point out it is up by 1% in the year-to-date column. Bloomberg Mag 7 Index up 1.4%. 10-year yield 4.55%. The 2-year 4.00%, and the 30-year 5.06%. Gold down 0.6%, 32.93 the ounce. West Texas Intermediate crude down 0.5 now, 61.23 a barrel. Bitcoin now at $111,800 on Bitcoin. It is up by 3.3%. Needless to say, Bitcoin at a record. Investors in clean power stocks running for the exits after a massive tax and spending bill that would gut former President Biden's landmark climate law narrowly passed the House of Representatives. Among some of those names, we've got Sunrun shares. They are plunging today. Sunrun is moving lower right now, down by 40%. Also lower. SolarEdge Technologies down 25%. Enphase Energy down by 19.2%. Couple of IPOs briefly. We've got Hinge Health up by 20%, and Mountain MNTN on the ticker up 53.3%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Carol Master along with Tim Stanovic live here on Bloomberg Business Week Daily. Our most read story on the Bloomberg at this hour has to do with the Trump administration telling Harvard University it cannot enroll international students. So no doubt about it, delivering a major blow to the school after the government, you might recall, also had frozen billions of dollars of federal funding and really escalating a fight that we are seeing between the United States and Harvard and other elite colleges, but really kind of taking this to a whole other level, Tim.
We got Kasia Klimashinska, team leader for DC Breaking News, joining us from our Washington, D.C. bureau. Carol read the headlines, Kasia, but I'm wondering about sort of, we're seeing the reaction, we're seeing the interest. Everybody's talking about this story right now. Is this the type of thing that is going to get legal pushback? Are lawyers already working on this to try to prevent this from happening? Or can the administration actually make Harvard do this?
Yeah, great questions. Thank you for having me. Indeed, this is currently the most read story on the terminal, and really a surprising new development, a major escalation where the Trump administration is basically telling Harvard they cannot enroll international students. Not only that, but also the currently enrolled foreign students have to transfer, or they will lose their legal status. Harvard has already responded, saying that they will fight it. That they obviously don't agree with this decision. So there will be definitely more to come.
You know what's interesting, Kasia? Like we've been seeing all of this play out, and I feel like universities have been trying to figure out what's the right balance in terms of dealing with the administration over it. I feel like money trumps everything, and financially, we are continuing to see impacts on universities because of what the administration is doing, pulling federal funding. But I look at Harvard, I mean, we keep reading this statistic. almost 6,800 students at Harvard, 27% of the entire student body come from other countries. That's up from just under 20% back in 2006. This is looking at the university's data. I mean, this becomes a bigger and bigger financial blow to the university. And you do wonder at this point, do universities in general, Harvard included, are going to fight back even harder because this is about money it comes down to, also in terms of principals.
Yeah, exactly. So this is more than a quarter of all their students. I think it's also interesting that this is the Department of Homeland Security getting involved. The statement earlier this hour came from the DHS, which was citing, right, the protests, the fact that they blame the Harvard leadership for not being able to keep its campus basically safe and putting some students at risk.
Yeah, I'm thinking about all the Harvard alumni in Congress right now. Harvard Law actually has an article on their website post-election touting the fact that all Harvard Law alumni running for re-election to Congress won their races, while 5 more alumni vied to join their ranks. They talked about incumbents in the U.S. House of Representatives. They also talked about Republican Ted Cruz, Tim Kaine, who were re-elected to the Senate, in addition to other alumni from Harvard Law School. Have we heard anything yet at this point from either Democrats or Republicans who were alums of Harvard University? Elise Stefanik, for example, who's been very critical of the school, Republican member from New York of the House. Have we heard anything from them since this came out?
It came out less than an hour ago, so I haven't seen anything here yet on the breaking news desk. You might. It's not only people in Congress, it's also major donors, right, on both sides. So I'm sure this story will continue to escalate.
Talk a little bit more about this coming from the Department of Homeland Security. Like, it's just interesting. It's kind of playing into kind of the safety element, right? We've seen this kind of being used, I feel like, in terms of security reasons. We've seen this with immigration in general. Like, that thinking and philosophy that continues to come from the administration, again, that I guess will also be discussed in any kind of legal arguments.
Yes, this timing is really interesting and really strange, given what happened here in D.C. overnight as well. And the statement actually specifically cites Jewish students. It's also kind of weird that the statement landed just after Caroline Leavitt finished her briefing, so that kind of didn't allow us to ask her more questions, even though obviously she must have been aware of it happening, because apparently there were some papers going back and forth between the Trump administration and the school for several days or even weeks now. So yes, this is definitely an interesting timing for this announcement.
I'm also thinking, and I know you're covering breaking news, but I'm also thinking about just the educational impact of a move such as this, given the numbers that Carol mentioned, thousands of students there, close to 30% of the entire student body. This is the type of thing that could potentially wreak havoc on a university's finances, but also in such a short period of time where ostensibly acceptance letters have already been mailed out. We understand the yield of the class coming in. The timing of this is pretty wild.
Yes, it's really strange and difficult. It's not only about the new students, but also existing students who will have to transfer or, lose their legal status. So that means losing their visa, possibly being forced to go back home. Yes, and it's not only about the finances, right, but also about the diversity of the campus. I mean, we know that the school has been previously attacked for their diversity efforts. So this also addresses that issue of the diversity of the student body.
Kasia, one last question. It's interesting that it feels like Harvard is being attacked big time. We've seen it also with Columbia and some other schools, but it does feel like, makes me wonder, like, who didn't get into Harvard and the administration that's like so angry? But I know it's a bigger, broader story. Having said that, should we assume that other schools will be targeted in a similar way as Harvard is being?
So I think this is what is very surprising about this news, right? That it singles out this one school and goes after its leadership. So I think we have to see. We have yet to find out whether the DHS will go after other schools as well.
Yeah, fascinating and disturbing. I think it's safe to say many would characterize it that way. Kasia Klimczynska, she's team leader for DC Breaking News, joining us from our DC News Bureau. There's a lot that is once again coming out of DC. We have actually seen shares of Fannie Mae and Freddie Mac surge to 16-year highs after President Trump said late last night that he was giving very serious consideration to bringing the firms public after more than a decade of being under government oversight. So let's get to what you need to know. Bloomberg Intelligence consumer finance analyst Ben Elliott is with us once again from our DC Bureau. Back to our DC Bureau we go. Hey, Ben, good to have you here. First up, Fannie Freddie, been around for a long time, storied history, quasi-government, publicly traded entities. What do we first need to know kind of about that history?
Yeah, so they were founded many decades ago. Fannie Mae first in the 30s, Freddie Mac later in the 70s. Actually, they were privatized in the past, in the late 60s, by a previous piece of legislation, which sort of has some echoes of what's happening today. And the companies basically guarantee 70% of U.S. mortgages. You know, their existence is unique globally, and it makes the U.S. home ownership model possible. And it's the reason that we have a 30-year fixed-rate mortgage available to homeowners today.
So what do we need to know about what happened potentially during the financial crisis and the government oversight that we've seen over the last few years, and what could change given what we heard from the president?
Yeah, so the companies are fundamentally changed since the financial crisis. It's important to note that they were doing all kinds of ancillary businesses. They were basically operating the world's biggest hedge fund, as Warren Buffett once said. And they got over their skis, taking on a bunch of additional risk beyond just guaranteeing vanilla mortgages. So the majority of the losses they suffered from 2008 to 2011 were from those activities, right? So they don't do any of that anymore. But, you know, they exist in this sort of quasi-governmental state where the FHFA and the Treasury own and are in charge of the companies, and by and large, they function very well. They provide a huge amount of liquidity to U.S. housing markets every year. They make the 30-year mortgage possible, and they earn about $30 billion a year for the Treasury Department. So the status quo is arguably working, but they're in sort of a bankruptcy-like process that was never meant to be permanent, and so there are a lot of observers who think that process should now come to an end.
All right, so you've got Fannie Mae up 40% in today's session. Freddie Mac is up just about 39%. So if they do go public officially and they're publicly held entities, what does it mean for them? What does it mean for their role in housing? How might that change things from what they've been?
Well, it's really important to note that there are very few details on this, right? So the president has been sort of saying what he said last night since 2017. So we don't have anything new, and the really important detail will be how, if at all, the U.S. government continues to back these companies after they exit conservatorship potentially and start to trade like normal public companies. And everyone, by and large, agrees that there will be some form of federal government guarantee. They hope it will be explicit. They hope it will be defined at a certain value, and they hope that it will be paid for. But by and large, the companies get a huge amount of benefits from being quasi-governmental. You know, their credit rating is tied to the sovereign, for instance. So they get very they get financing on par with the risk-free rate, essentially, which allows their business model to function at the prices it does today. So if the companies were to exit conservatorship, you know, it's not necessarily true that mortgage rates will rise, but there are plenty of ways in which they could. One is that the companies choose to or need to earn more profits to attract third-party private capital to replace the government's current stake. And the other way is that agency MBS investors lose faith in their backing. And they start to see credit risk returning to the securities, and therefore they demand a larger premium over treasuries, and that translates into higher mortgage rates.
What does it mean exactly when you say that the U.S. has a stake in these companies? Because, you know, I go to HDS on the Bloomberg terminal to look at these equities to see who the holders are. It doesn't say the U.S. government owns X percentage of these firms.
Yes, actually at Bloomberg we do an interesting thing, which is that we display the share count as though the Treasury had already executed its warrants. It holds warrants to buy 79.9% of the common stock, but they're not actually exercised yet. So the federal government is not reflected as an owner of the common shares. What they do own is something called the senior preferred shares, which obviously, as the name implies, are senior to the common shares. And the valuation there is something called the liquidation preference, which is growing each quarter equal to the amount that the companies earn, and it's approaching $400 billion. So that's kind of the biggest impediment to this recap and release process that you hear about, is what does the federal government do with this gigantic stake in the companies, and how does it get paid back?
Yeah, because I wonder, like, if the government is still somehow involved, is it kind of a sure thing for investors? Maybe not a high flyer, but a sure thing. And I also do think about, like, moral hazard. Like, if something goes astray, like, do we just assume the government's going to be there to protect things?
Yeah, I think there's the biggest risk is obviously moral hazard, right?
Right.
If they leave conservatorship and there's a defined dollar amount that the Treasury agrees to backstop the companies, and they pay for it, I think even then bond markets will assume that if worse comes to worst, the federal government is going to write a blank check. The companies are absolutely fundamental to the U.S. economy, and if they were private enterprises, there's just no way that they could, go into bankruptcy and be resolved simply. And the evidence of that is 2008, right? It's staring us right in the face. So it does seem as though there's some circular logic here,
right.
Like we'd be going right back to where we were.
Ben, 15 seconds. How important is Fannie and Freddie in terms of the housing market, the liquidity, just very quickly?
Absolutely crucial. They back 70% of all U.S. mortgages, and without them, the fixed rate 30-year note just wouldn't be available the way it is today.
This is what you call an interview. Why you should care. Ben Elliott, thank you so much. Really appreciate it. Bloomberg Intelligence consumer finance analyst Ben Elliott.
You know who the top holding is? Pershing Square at 2%.
Love this stuff. This is Bloomberg.
You're listening to Bloomberg Business Week Daily with Carol Masser and Tim Stennebeck on Bloomberg Radio and Television.
All right, everybody, just coming up on about an hour away from the closing bell. We've got stocks hovering near their highs of the session, so we're up about 24 points, 0.4% on the S&P 500. NASDAQ 100 up about 150 points, a gain of 0.7%. Watching the yield curve, we talked about that a lot today. And what we're seeing in treasuries feels like things settling down a little bit. 10-year note with yield of 4.54 as we speak. 2-year note with yield of 3.99. So maybe settling down just a little bit.
And just a little deep tease for
really
our next
the long
hour.
end that everybody's been focusing on.
Yeah, we're going to be focusing on that with Liz McCormick and also with Kathy Jones over at Charles Schwab. Just a deep tease.
Yeah.
I'm Tim Stennebeck along with Carol Masser. Let's take a look at some stocks that are on the move today. With us is Bloomberg News Equities reporter Red Brown. He joins us in the Bloomberg Business Week studio. On your radar today, you had a lot to choose from.
Yeah, there was a lot of red to choose from. Stocks are up a little bit. But yeah, I think one place to start with and kind of topical to the big news from today is Enphase leading a lot of these solar companies and renewable energy companies down today after we got a look at the House version of the Big Beautiful Bill, which ended up gutting energy subsidies a little bit more than was expected. I think if we can think back just a couple of weeks, there was actually a lot of optimism around the same topic, that the version of the bill that went to the Ways and Means Committee, that draft bill, was actually a little bit kinder on these subsidies than was first expected, or feared, I guess would be a better way to put it. But now we're actually getting the version of the bill that passed the House much worse than feared. So, this is an industry that's very reliant on government help to get these big capital-intensive projects underway. So now there is a lot of kind of worries that, we won't be seeing that money flowing in the future.
Number one decliner, forgive me, in the S&P 500. Now you've got Enphase down about 44% year to date. So just really big hit. Another decliner, Williams-Sonoma?
Yeah, Williams-Sonoma trading down around 4 or 5% kind of all day today. And that's despite posting sales growth that actually blew past analyst expectations. Analysts were expecting sales to grow less than 1%, and the company actually posted a little over 3%. So a little bit surprising, I think, when we look at just the top level. The problem is the company did not pass that on to their full year guidance. So if we've seen this come up on a few of these retailer earnings results this quarter, that companies are doing well, but they're not passing it along, and the reason being is maybe some consumers are pulling forward their demand, right? So the fear is, if I'm worried about tariffs, I'm going to buy my sofa, buy my kitchen, my stand mixer now, right, before the prices go up.
Right.
But then I'm not going to be doing that in the fall or the summer or what have you. So the demand, the sales get a little lumpier. Okay,
Speaking of sales and speaking of retail, shares of Target, yesterday they fell 5%. It's on your radar today.
Yeah, for that exact reason, because a bit surprising to see it bounce back just a little bit. We're seeing some kind of tepid buying activity for Target, despite that really another disappointing quarter for the company. It's been kind of a recurring theme for Target. The company cut its full year sales targets as it's really struggling to attract customers. It's losing a lot of ground to Walmart, kind of its closest competitor, although not an exact comparison, right?
Right. Not really the same, is it?
No, I mean, this was the point that Jen Bartoshis made recently, which is Walmart is a little insulated from some of the challenges that Target has, just because so much of what it sells is groceries,
right?
which are not considered discretionary. But Target has the issue where this is discretionary spend, and if consumers are pulling back on discretionary spend, then that's a challenge for the company.
Exactly, and worse than that too is like Walmart is making grounds in that discretionary area because they've been investing so much in the lower cost goods, right? So Target can't even necessarily compete in that area where historically they've been much more successful and competitive with Walmart. So now, because of the string of bad results, there's some questions around, is the right management team in place to get this company out of this rut, right? But today, stock is up, and I think that might be a little bit of acknowledgement from some investors that it's still a strong brand, right? Like, we all have memories with Walmart, shopping there, and valuations right now you'd have to go back to late 2011.
Walmart or Target? You mean Target?
Target, right?
Yeah.
So,
or Target, as we used to all have so much fun.
Right, see, that's the strong brand right there, is Target. But yeah, you'd have to go back to late 2011, early 2012 to find a time when the valuations for Target were this low consistently. So, I think maybe people recognizing a little bit of a buying opportunity for Target.
It's really fascinating too, because I always love kind of the analyst community. Did you see the story that analysts at B of A, Telsey Advisory, a bunch of them, apparently they have downgraded due to those disappointing earnings, downgraded Target. And so this story by Joel Leon saying Wall Street's enthusiasm for Target is at its lowest in 6 years. So it's interesting to see the bounce back. There's obviously investors who see opportunity.
Yeah.
Despite those calls.
Maybe sometimes those sell ratings are a buy signal for some people.
Listen, they're always so, like, I know.
It's a weird balance, huh?
They are fun to watch. Red, thank you so much. Really appreciate it. Bloomberg News equities reporter Red Brown. Listen, for more conversations, check out our new Stock Movers podcast. It's 5-minute episodes, biggest winners and losers in the stock market. You can find it on Apple, Spotify, or wherever you get your podcasts.
All right, equity market in the green, higher by 0.5 percentage point on the S&P 500. The NASDAQ composite up 0.9%. The Dow up 0.4%. Over to the bond market we go. We're seeing yields lower across the curve. The 30-year, 5.06%, while the 10-year at 4.55.
30 years still up there, huh?
Oh, yeah. That's what we're talking about next, by the way.
Yeah, I know. We're going to really dig into this. I mean, I just feel like taint over, folks.
No.
Especially as we watch it, the bill making its way. For those watching on TV, the close is coming your way in just a moment. Do not go anywhere, though. We're counting you down to the close. An hour to go. Right here on Bloomberg Business Week Daily.
CBS News on the Hour, sponsored by O'Reilly Auto Parts.
Michael Wallace, President Trump is turning up the heat on Harvard, barring the university from enrolling international students.
Harvard University said in a statement the government's action is unlawful, calling it retaliatory and saying it threatens serious harm to the Harvard community. Homeland Security Secretary Kristi Noem says she's ordering her department to terminate Harvard's student and exchange visitor program, which would mean it could no longer enroll foreign students, and existing foreign students must transfer or lose their legal status. The university says its students and scholars are from more than 140 countries. Wendy Gillette, CBS News.
At least 2 people were killed and 8 injured when a small plane crashed into the nation's largest military housing neighborhood in San Diego. Assistant Fire Chief Dan Eddy.
Crews did a great job working with San Diego PD to start evacuating the neighborhood and with the military to ensure that we are doing the right things to work with the military on that.
No one on the ground was killed. Police say the 2 Israeli embassy staffers who were killed outside the Capitol Jewish Museum in Washington were targeted. CBS's Anna Schechter says the shooter eluded security in the area.
He was carrying his weapon and was walking down the sidewalk and just walked right up to the museum and was pacing around in front of it. But there was nobody that was alerted to it. So it was like a brazen act that he was able to carry out.
The suspect yelled "Free Palestine" as he was taken into custody. The Atlantic hurricane season begins a week from Sunday. Ken Graham is the director of the National Weather Service.
We're predicting an above-average season once again, 2025.
But will FEMA be ready?
I'm Dave Malkoff in Tylertown, Mississippi. It's been 68 days since the last time we were here after a deadly tornado. All the survivors I've been talking to seem to have the same basic story. They applied for federal disaster assistance shortly after the tornado, and that's the last time they've had any contact with FEMA.
The Trump administration is challenging a policy meant to protect child migrants.
The administration has filed a motion to end protections granted through what is known as the Flores settlement, which limits to 72 hours the amount of time child migrants can be held in the custody of U.S. Customs and Border Patrol. The settlement, which has been in place since the 1990s, is named for a Salvadoran girl named Jenny Flores, who alleged widespread mistreatment of migrant children. In addition to limiting the amount of time children can be held, the Flores settlement requires that children are granted safety, adequate food and water, and sanitary conditions. Linda Kenyon, CBS News, the White House.
With an hour to go in the trading session, stocks are higher. Dow's up 188 points. The NASDAQ is up 169. This is CBS News. Some presidential artifacts have sold at auction for big bucks.
When the bidding was over, someone had paid more than $1.5 million for a pair of blood-stained white gloves that were in Abraham Lincoln's pocket the night he was assassinated. Also sold, 2 handkerchiefs Mr. Lincoln had with him at the Ford Theater on April 14, 1865. They went for $826,000. A wanted poster with photos of the shooter, John Wilkes Booth, and 2 other suspects in the assassination conspiracy brought in $762,000. The money will pay off the remainder of a 2-decade-old loan the Presidential Foundation used to buy a one-of-a-kind collection of Lincoln artifacts from a California collector. Deborah Rodriguez, CBS News.
A homeowner in Norway calls it his bulky new neighbor. A huge container ship ran aground just feet from his home in a fjord near Trondheim. No one was injured, but a heating pipe to Johan Hellberg's cabin was damaged. Michael Wallace, CBS News.
This is Bloomberg Business Week Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Business Week Daily with Carol Masser and Tim Stenovec, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
And a very good afternoon, everybody. We are continuing here on Bloomberg Business Week Daily. Carol Master, Tim Stanovic, and we've got a market, equity market. Hey, folks, we're seeing some buying here in this last hour, taking a leg up, getting to our best levels. We'll get to the numbers in just a moment. It feels like a little bit of a calming down after yesterday's focus on the Treasury market. Why are you smiling?
Half a percentage point gets you this excited?
No, I like when I see buying or something into things. You know what I mean? Like into the close. Now you
you
know me. You know me. How many
spike
times
up
I'm like,
here.
guys, it's not such a big percentage movement.
Little spike up. I guess it's the context too of what happened yesterday, and we were lower earlier in the session.
We're getting ready to go into a long weekend. Like I know we have one more day of trading.
I'm getting ready for that.
Yeah.
Yeah.
We were ready on Monday.
Hey, the bond market is really our focus
Yes.
in the first hour today. We're going all in there. We got a great group of voices. Liz McCormick, standing by in New Jersey. We're going to be talking to her in just a minute. Kathy Jones of Charles Schwab is going to be joining us a little later as well.
All right, looking forward to that. We're also all in on artificial intelligence. Our AI reporter, Rachel Metz, on the OpenAI mega deal. We've talked about this, who to watch in the industry, and Claude's update. So we'll get into that. And one more thing we've got.
Yeah, the tariff-free way to reindustrialize America. It is in Bloomberg Business Week. We got one of the co-authors joining us there a little later. All that and more coming up on Bloomberg Business Week Daily over the next 2 hours. First up, though, check of the day's trade and top business stories. Here he is, Charlie Bellet.
Thank you very much, Tim. Can we call it the big, beautiful bull? We've got the Dow, the S&P, NASDAQ all advancing here. Stocks, however, staging a cautious comeback in the wake of that Treasury sell-off that shook markets around the globe amid fiscal concerns. Stocks, bonds, and the dollar all posting gains. S&P up 29 now, 58.74 where we stand, up 0.5%. The Dow up 182, up 0.4. NASDAQ up 177, up by about 0.9%. The 10-year at 4.54%, the 2-year 3.99%, 30-year 5.05%, gold down 0.5%, 32.97 the ounce, crude retreating by 0.6%, 61.22 a barrel. Bitcoin major move there, up 3%. Bitcoin with a $111,000 handle at 111,500 on Bitcoin. As for the market backdrop, Nisha Patel is fixed income portfolio manager at Parametric Portfolio Associates.
Equity market is saying, look, everything's good, nothing to worry about. A lot of optimism, I think, in the equity market. I would argue in the bond market, we've almost priced in a lot of what has been feared, right, especially in the debt and deficit side. So I think this is kind of a ceiling where you start seeing buying opportunities.
And again, the 10-year 4.54%. First day out for Hinge Health and Mountain. Hinge up 17.9%. Mountain up 51%. Briefly, retail earnings this morning. Urban Outfitters shares, they're up by 22.9%. Ralph Lauren up 1.3%. And BJ's Wholesale Club trading lower by 1.5%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thank you so much for that update, Charlie Pellet. Really do appreciate it. That's Carol Masser. I'm Tim Stenovec. We just got an update on the equity market from Charlie, seeing some green on the screen there. Also, when I go to the bond market, I see that the 30-year right now is still up over 5%, Carol. 5.05%, but down ever so slightly from what we saw yesterday.
Yeah, and we did
ever so slightly.
Exactly. We saw 30-year hitting at what, a near 2-decade high on Wednesday, hitting about 5.1%. So listen, we are certainly focused on it. Curious to see what Liz McCormick has to say about what we've seen in the last 24 hours, where we are today, and what's going to kind of move yields certainly to the upside or downside based on maybe administration policy and more. Liz McCormick is chief correspondent for global macro markets for Bloomberg News. She's got a great story on the Bloomberg that is among our most read. She joins us right now from New Jersey. Hey, Liz, the last 24 hours, I do feel like, the Treasury market is very quick to say, kind of wave its finger at the folks in Washington, and yet then we settle down. So help us make sense of what we saw in the last day or so.
Yeah, gratefully we have a little calm today, but I think, we've settled down, like you and Tim were saying. We still have 20-year, 30-year yields slightly above 5%. I think the market, if you look at a lot of the analysis out there, says, we've come a long way, right? If you look at some of the metrics of risk premium in the marketplace, like the term premium, like the bond folks like to talk about, which, Carol, you probably know, over the last 5 years, it averaged negative because we had those low rates and whatnot. Now it's about a full percentage point. So the bond market is priced in, hey, we need some compensation to invest in the long end. We have this yield curve very steep. If you look at 5s to 30s, is almost a full percentage point positive. So I think they have come a long way. They've kind of priced in this deficit picture and the outlook for the debt. We still have to get this bill, as you know, through the Senate. And but I think the expectation already is, so it's always about expectations, that it could get a little bit worse, because they might, not want to cut spending as much. So from here, I think it's going to be like, is there a new catalyst, right? That turns this further? Like, is something happened which I don't expect, that the deficit picture looks really terribly worse after the Senate, or let's not forget the economy and all that stuff we've kind of forgotten about, right? If we've kind of priced out a recession, if that continues, we have inflation data next week, the Fed's favored measure, right? I was talking to Katie Kaminsky, who I know you guys know, yesterday, and she was saying to me, Liz, for now, this is not an inflation thing. They're kind of short on the long end, but she said, if we start getting inflation, that's another leg. We could get catalysts to bring it up. Otherwise, for now, like you said, some buying came in, 5%, pretty attractive, for the long end.
I love that you went there. We talked about this with Ira Jersey a little bit earlier. It's so interesting. We are in this environment where things like eco data or the PMI numbers, that came in stronger than forecast, the economy's growing, but it does make me think about inflation too, but it's gets overshadowed, Tim, by so much.
Yeah, well, I think the question then, I also asked Ira this question, but would it be a stretch to say, Liz, that bond vigilantes made an appearance yesterday?
Yeah, I don't think, everyone says, and they tell me, Liz, chill out. We're not seeing that kind of, let's say, panic mode. I get it. I've been around for a while. But the increase we've seen in yields in the recent weeks, and like you said, Tim, since the Friday downgrade from Moody's, I would say bond vigilantes are raising their head, to push everything above 5%. Like Stephen Jan, who said we might have a Liz Truss moment. I don't know that we're quite there. I did have an investor say to me, hey, the 30-year bond auction, which comes in mid-June, we saw what the not a good 20-year did, kind of kick things up. He said, I'm really worried we could have a huge tail, 10 basis points. So there are people already looking at this next big, long-term debt auction, which is a bit away. So, but I think for now, the bond vigilantes are flickering. They haven't caused complete panic, but they're there.
So the point is, Liz, listen, my name is Carol, and I understand the equity market more than I understand the Treasury market, which is why I always lean on someone like you. I learn from you. But the point is, investors are not willing to maybe make that bet longer term, right? Because maybe they're thinking, I don't know, they're a little bit worried about the fiscal position of the U.S. government. We talked about with John Authers, it's not just U.S., it's global. Japan, other governments having issues too in terms of their fiscal positions. But is it also, are they worried about, I don't know, instability in the government? Like, well, how do you read these trades? Are they anticipating that, listen, you guys are going to have to do other issuances, I should say, and you're going to pay us even more, so I'm going to wait for that? Like, how does this work, or how does this play out potentially?
Well, I think, for investors, especially bond investors, it's all relative value, right? So many, and for a while now, and they're leaning further into, have said, like, yes, if they want treasuries, yes, some of them still think it's a hedge vehicle, kind of ballast in your portfolio. But why do I need 10 years or 30 years? Forget 30 years. I like 5 years, 7 years, right? I'm getting a little bit of duration. I'm getting less of this risk like we're seeing play out in the long end. I find a lot of people are saying that hey, what's the incentive for me? There's too much risk if I go out the long end. Of course, if we have a terrible economy and we implode into a huge recession, duration is your biggest friend, right? Rates will go back down the fastest there, but that hasn't, quite worked out. I thought Greg Peters of PGIM was on TV this morning. He was great. He said, like, the long end is like a duration stripe now. You know what I mean? Like, it's trading like a risky asset. Why buy it, right? So I think that's what's going on.
And so why not, like, buy the belly of the curve? You get 4.1, right, on a 5-year without having to go all the way out for a 10-year where you only get, you're getting 4.5. So you're only getting a little bit more.
Yeah. Or, we still have $7 trillion in money market funds, right? I always say the rich capos call me, the brothers, and say, I'm making good money on a money market fund, like the kind of average person. It's not a bad return, right?
Hey, Liz, just right now, how would you say the treasury market is competing with debt issued by really solid corporations? Because we've had some folks on our air come on and say they're ignoring the treasury market and they're buying corporates right now.
Yeah. Oh, I'm so glad you asked me that. That's like my favorite thing. I was going to say, don't say it again, Liz. But I mean, you definitely hear everyone saying to me, like, Liz, look at Microsoft, look at these companies, and plus some of those have a AAA and the U.S. doesn't now, right? It's a good return. The balance sheets look better. If I want to go longer duration, why would I go to the U.S.? So I do think that you see people saying, these high grade corporates look attractive. We have the credit spreads have come way back in again. So I hear that a lot from investors. A lot of these doing like kind of ag type portfolios where they can, invest in anything. If they want safe stuff and they want a good yield, they're going for corporate. I think a lot of them, as opposed to like a long duration treasury.
At some point you said in this interview, you're seasoned, and people were saying like, calm down, Liz, calm down, Liz. But you've seen a lot of cycles, and we've seen real crisis, right? Whether it's, the great financial crisis and other moments, the Liz Truss moment, there's times that we see crisis in the treasury trade. Are we seeing any signs of that? Or what are you watching out for that would say that maybe there is some bigger concerns here?
Well, it's if it keeps going, right? I mean, okay, like someone said, we can kind of handle the system with 10-year treasury yields around 4.5, right? But if they kind of blow past 5 and keep going, the Barclays folks had a great note where I won't get into all the bits of it, but they talked about one thing in the market, the bond market, is that people are focused more on the deficit sensitivity of interest rates, meaning our interest costs were running over like $1 trillion annually, right? Because rates have gone up so much, it's more than defense. So people are also doing the math in the back of their mind that, interest rates keep going up. That's adding to the deficit problem, right? Because we have to pay more interest just to service the debt. By the way, Scott Bessent's on TV tomorrow. We're all going to be watching to hear what he says. Can he bring calm to the market? He'll be on Bloomberg.
He certainly has been the person to watch when it comes to some concerns or nervousness in the financial markets. Hey, Liz, thank you so much. Liz McCormick, she's chief correspondent for Global Macro Markets. Coming up, AI.
It's 3:21 on Wall Street. We do check markets all day long here at Bloomberg. We have got the Dow, the S&P, NASDAQ all pushing higher. 39 minutes to go ahead of the closing bell. And this Bloomberg Business Flash is brought to you by ShipStation. Calm the chaos with the shipping software that delivers. Use code Bloomberg for a free trial at ShipStation.com. That's ShipStation.com with the code Bloomberg. Wall Street staging a cautious comeback in the wake of the Treasury sell-off that shook markets around the globe amid fiscal concerns. Right now, we have got the S&P 500 index climbing higher by 27 points at 5871, up 0.5%. The Dow up 177, up 0.4. NASDAQ up 164, now up 0.9%. 10-year at 4.54%. The 2-year 3.99%, the 30-year 5.05%, gold down 0.6%, 32.94 the ounce, and West Texas Intermediate crude down 0.6%, 61.22 a barrel. Bitcoin at 111,821. That is a record. Investors, meanwhile, concerned about the nation's debt burden, and they're also keeping an eye on the economic data. Alicia Levine is the head of investment strategy and equities at BNY Mellon Wealth Management.
So it's less about the tax bill itself and the effect of the taxes on growth. Yes, we want to avoid the negative fiscal drag of the $400 billion if this doesn't get through. The real issue is, I think, the deregulation and what's embedded in the bill, which is the immediate expensing of investment, the immediate expensing of CapEx and of building structures. That's actually very growth positive.
BNY's Alicia Levine interviewed on Bloomberg Surveillance, and you can hear more of the conversation on the Surveillance podcast. You can download it wherever you get your podcasts. Investors in clean power stocks running for the exits after the massive tax and spending bill that would gut former President Biden's landmark climate law narrowly passed the House. Right now, we have got shares of Sunrun plunging 37.8%, also moving lower. SolarEdge Technologies down 23%, and Enphase Energy down 17.6%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Hey, thanks so much for that update, Charlie Pellet. Really do appreciate it. Carol Master, when I got off air yesterday, I had text messages from a few friends who work in tech who were like trying to wrap their heads around what exactly is happening with this OpenAI deal for Johnny Ive's company. I mean, this is a guy who's legendary when it comes to consumer technology. He had his hand or his vision in creating the consumer tech gadgets that we use every day from Apple. I mean, I'm talking about the iPod, I'm talking about the iPhone, I'm talking about everything.
Incredible design, right? Like things that are just, when you think of a well-designed product, you think of Apple products, and you have to think of Johnny Ive. Just to remind everybody, the stories, we talked about it yesterday, OpenAI will acquire the AI device startup co-founded by Apple veteran Johnny Ive in a nearly $6.5 billion all-stock deal, joining forces with the legendary designer to make a push into hardware. It's something we talked about with our Mark Gurman about, like, kind of what kinds of hardware, might ultimately come out, and we start to speculate. But we've been wondering where Johnny Ive, what he's been up to, what is he doing, right? Kind of it's been kind of quiet. We haven't really talked about it for a while since he left Apple.
Yeah, a couple different companies, one that has designers, one that has hardware. According to our own Mark Gurman and Shireen Ghaffari, the purchase will provide the company, OpenAI that is, with a dedicated unit for developing AI-powered devices. What do those devices look like is the question I have. There's a lot of speculation online. Ed joined us yesterday to talk about that Humane clip that was a huge dud. That was also founded by some veteran Silicon Valley folks, raised a ton of money. There were a lot of eyes on it in the last couple of years. That thing was a huge dud. They ended up basically selling it for scraps. But that's what the speculation is. Could it be something like that?
And forgive me, I think I said Mark Gurman, but I think it was it Shireen and Ed that we talked to about this?
Yeah, and Mark wrote the piece, and we spoke to Shireen and Ed yesterday. And Mark and Shireen wrote the piece.
What?
Mark and Shireen wrote the piece. We got a lot of great reporters here helping us
They're
out.
incredible. Another great reporter is our own Rachel Metz, because there is a lot going on when it comes to AI. And we should point out the Bloomberg Tech Today conversation is brought to you by Cisco. AI moves fast, and the path forward isn't always clear. Cisco giving you the infrastructure, the security, and observability to stay on course. Cisco, making AI work for you. Visit cisco.com I
want to bring in Rachel Metz. We've been eager to speak to her since the news broke yesterday that OpenAI would buy Johnny Ive's AI firm for $6.5 billion. Rachel is Bloomberg News AI reporter. She joins us from our San Francisco bureau. Rachel, an acquisition such as this, we're trying to imagine what a piece of hardware from Johnny Ive and OpenAI look like. What does it look like to you?
Oh my gosh, that is a really good question. I mean, I could make guesses, but I have no idea. Do you want me to make some guesses?
I do.
Based on
Absolutely.
my past covering? Because I actually, before I started covering AI a number of years ago, I did a lot of consumer tech coverage and a lot of wearable coverage. Actually, that was like a big part of what I did. So I'm gonna say it's possible that they're working on something that is like a device that you'd have in your home, so maybe some sort of speaker thing. I like that. I could see that, or something that would go in your ears. Some sort of earbuds, possibly something glasses related. But that is really, really, really tricky. So many companies have tried and failed at that. Anything on the body, I'm gonna guess probably not, unless it's a super. A category we're super used to seeing, like earbuds or glasses. I think one of the problems with the Humane Pin that has bogged down a lot of other wearable companies in the past is it is so hard to get people to wear something on their body. Ignore how well or badly it works. Just getting someone to wear something and to wear it consistently is very, very tricky.
Yeah, do I want to walk in a bathroom with a clip on me that has a sensor or camera on it?
I don't.
Seriously.
But I don't. Most wearables, and especially jewelry wearables, I remember a number of years ago, people were trying to push those. And it is just so tricky to get people to change habits, and to get used to putting something on all the time. What if it doesn't go with your outfit? What if it makes other people uncomfortable? There's a lot of things to think about. But I do think it's interesting that they're thinking about what could be the next device category. I'm really curious if it's going to be something that we hadn't even considered. But I guess we'll have to wait and see until sometime next year.
It's funny you mentioned glasses and Apple. Mark Gurman just out with a story, 10-15 minutes ago about Apple aiming to release smart glasses at the end of next year, part of a push into AI-enhanced gadgets. But it has shelved plans for a smartwatch that can analyze its surroundings with a built-in camera. Does Apple need to be worried about this collaboration, Rachel?
I think potentially over time, it's sort of unfortunately and not satisfyingly, it is sort of it remains to be seen, because they've been super cagey about what they're even working on. What is the prototype of? What exactly did OpenAI buy? It is not 100% clear to me, and I don't know if anybody even really knows. So, and I think they're trying to keep it more secretive than a lot of their other efforts. So, we'll do our best to endeavor, find out what's happening, but we might not know until we know.
Well, something we do know is that Anthropic is finally rolling out those new versions of its Claude AI software, including a long-delayed update to its high-end Opus model as the company vies to stay ahead of a crowded market. We're talking about Sonnet 4 and Opus 4. For those at home having trouble keeping this stuff straight, this is Claude, which is a competitor to OpenAI's ChatGPT. I actually downloaded and played with it a lot over the weekend, but I'm using Sonnet. What's this, and how is it different?
How is Sonnet? You're saying how
I'm using the free. I'm using the free version of Sonnet.
Okay.
Right now.
So right now they just have they have these two new models, the new version of Sonnet and the new version of Opus. Opus is essentially their flagship model. This is the new version of the flagship. They haven't had one for over a year actually, which in AI time is a very long time. They had released an older version of Sonnet and of Opus, and yet one more model that they have. And these are all the different models that power their Claude chatbot. And this was last spring. And then they released a couple updates, and they said an update to Opus, the most powerful one, was coming, but then it never materialized. So I spoke to the company about it the other day. I spoke to Mike Krieger over there at Anthropic, and he said that basically what happened was they didn't feel like the model they prepared, the version of Opus they had prepared, was like better enough than Sonnet, which is a slightly less powerful model. A lot of people use it for coding. They didn't feel like it was like differentiated enough, so they decided to hold it back. And what they have now is they feel a better model.
I shared with Shireen earlier this week on our air that because she wrote about Claude and a big profile of Dario Amodei, the CEO and one of the founders of Anthropic, that I discovered Claude Sonnet, the one that I was using, was disconnected essentially from the web because I asked it a question and it told me it couldn't answer because its training stopped in, I believe, October of 2024. Does Sonnet 4 mean that its training goes later, like until like March or April or even May of this year? Is that how it works?
That's a good question. I'm not sure for these two when they were trained up until, but probably it would have been trained until more recently. But I'm not. Yeah, that's a good question. I'm not sure exactly when. However, what they do have is these models can access the internet, especially in certain cases. What they can do is a thing called tool use, so they can use other software to help answer questions. So if you ask a research question, let's say you have a bunch of different medical symptoms that you're asking it for help, trying to brainstorm what the problem could be, and you want to use, it's got like an advanced, like a lengthier quote unquote thinking mode. So you want it to use more compute, spend more time going over a problem. It could also go onto the internet, for instance, maybe look up some medical papers and sort of bring those things in. So yeah, it does have access to the internet, but in certain ways.
That's a good point. I just asked it while you were talking. Excuse me, forgive me. My reliable knowledge cutoff is the end of January 2025. This means I can answer questions about events and information up until that point, but I cannot provide reliable information about anything that happened after January 2025.
Full disclosure. Rachel.
For that, you can come to me.
I love it.
We will. So, I mean, all of these things, ChatGPT, Gemini, Claude, like, are we just going to be using multiple ones? Like, I don't know. I'm trying to understand the way forward here.
That's a really, oh man, I think about that a lot. Like, because I can't really tell what people will be doing with these over even like the next year. I think that it would make sense for people to be using different products for different things. I mean, that's how we're already used to using software in that way, right? So I think it kind of depends, but maybe you might have one that's more your primary. I know some people say they really like Claude. They like the tone of it, for instance, or they use it a lot for coding. Right. Other people like ChatGPT. They might, for instance, like the voices. And Claude and the models Anthropic's building are more aimed at enterprises. To be fair, ChatGPT I think of more kind of as a prosumer product in my mind. It's good for consumers, but it's also meant for businesses. So I'm going to say it's going to be a multitude. In the best case scenario, and that would probably make a lot of companies happy.
Listen,
right?
when we were, exactly. When we were preparing for you, we're like, oh my God, there's so much to talk to Rachel about. You've got a great story on the Bloomberg about ones to watch in terms of AI. We've only got about 20 seconds. Just tee it up how people should, use it for what? To just kind of names they need to know real quickly.
Yeah, Ones to Watch is a list that we've done for a while annually, and it is a great way to look at some names and some companies of people we think you should be keeping an eye on, especially over the year going forward.
And we're going to have you back, I think, because we should really go through this list. I think this is an important one. So always so much to talk about with you. Rachel Metz, Bloomberg News AI reporter. There's a lot going on there.
It's 3:40 on Wall Street. We do check markets all day long here at Bloomberg. We have got the Dow, the S&P, NASDAQ all advancing. In fact, the S&P holding close to session highs. Right now, let's head over to the first word breaking news desk for today's afternoon call. Here he is, Bill Maloney.
And good afternoon, Charlie. That's right. U.S. stocks with a bid in a choppy session today. The Dow is currently up 181 points. The S&Ps are higher by 0.4%, and NASDAQ rises by 0.7%. The U.S. 10-year yield is at 4.54. Gold and oil are in the red, but Bitcoin is climbing. That's up by 3%. Among the main 11 S&P sectors, leaders were consumer discretionary and telecom. Utilities were under pressure, and leaders to the upside in the Dow, Nike and NVIDIA, while UNH fell 2% and led to the downside. After earnings, Snowflake jumped 13%, and the tech space, Amazon spiked intraday after Pershing Square disclosed a new position, and Seagate spiked intraday on a very upbeat investor day. Wrapping things up, Intuit, Workday, and Autodesk all report after the bell. Live from the first breaking news desk, I'm Bill Maloney. Charlie?
Okay, we thank you very much, Bill Maloney. And again, we'll be all over those earnings as they break. And to hear live breaking news over your Bloomberg, type SQUAWK, SQUA, on your Bloomberg terminal. I'm Charlie Pellet. That is a Bloomberg Business Flash.
I'm driving in my car.
How about you let me drive?
Oh, no. This is not a toy. Who's gonna drive you home? Honey, please, I'll do the driving. Drive on. Excuse me, I don't want to drive. It's the question that drives us.
This is the drive to the close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, everybody, we're just about 18 minutes away from the closing bell on this Thursday. Carol Master along with Tim Stanovic live here at our Bloomberg Interactive Brokers studio. Charlie and Bill Maloney breaking down the trade, talking about the equity trade. We're pretty much hovering near our best levels of the session, but what we really want to get into is what we've been talking so much on the fixed income side of things, and in particular, U.S. Treasuries.
Sometimes you have the perfect guest for the moment.
We really have the perfect.
And this is one of those times. We've got Kathy Jones with us. She's Chief Fixed Income Strategist at the Schwab Center for Financial Research, and she's here in our Bloomberg Interactive Brokers studios. Thanks for coming in. It is always great to see you, especially in a week where we're talking about over 5% on the 30-year.
Well, thanks for having me. It's a fun time to be talking about it.
So what would you say is the underlying root cause of what we saw happen yesterday?
I think there are a number of things have come together. So it didn't just happen overnight, obviously, but the initial catalyst, or the immediate catalyst, was the budget bill, which was kind of the final straw for the market, saying, okay, there's really no meaningful progress going to be made anytime soon on reducing the deficit. And this comes after we've seen global yields rise, after the dollar has fallen, and we've made all these policy changes on trade that actually will discourage capital inflows. And so this policy mix combined with the budget said, okay, if I'm going to hold long-term paper, I'm going to need a higher yield to compensate me.
But that bill is now closer to becoming law. And we're seeing yields actually pull back a little bit. So in my view, and correct me if I'm wrong, nothing has really shifted on that front, yet we're not seeing as much excitement, or in the words of the president, maybe yippiness in the bond market.
Yeah, well, I think a lot of the yippiness happened when we hit 5%, right? And so now we're settling down and kind of dealing with what's
so we don't stay yippy even though we're above 5%. Just the fact that we hit it is yippy.
Well, yes, but we have a one-day reprieve, so we don't know what's coming. But I would have to say that if nothing changes on the policy front, the likelihood is that yields will continue to rise at the long end, just because investors want more compensation for all the risks that have been put together here.
One thing I want to get into is, and what I'm finding interesting, is this just isn't a U.S. thing. It's a global thing. And we talked about this with our John Authors, who has a column out. He said the bond vigilantes, may need a lot of rope. And so, but getting into, he said, even some bigger things, not just governments, fiscal, houses, longevity, costs to society, and just a different way of thinking of it. And I'm just curious how that plays into your thinking as well, Kathy.
Yeah, absolutely. Demographics are important here because we do have aging populations, and that means the burden on government will be higher, presumably, than it has been in the past, as a larger proportion of the population requires government services. And we haven't done anything to kind of address that imbalance longer term. So that combined with, we've come off 20 years of slow growth, low inflation, and ramped up our spending. And now we're ramping it up more at a time when the economy is actually doing well and inflation's not low and interest rates aren't low. So we're kind of having the policy impulse, the fiscal impulse is going in the wrong direction at this stage of the business cycle. Usually it should be counter-cyclical, and this is pro-cyclical.
Are you worried about these spending programs ultimately will lead in some ways maybe to stagflation? And I'm just thinking about if we're living in a higher rate environment, that's going to have a cost, right? Across the board, everybody, everything. And I'm just curious, as we continue to see, we're probably going to still be in a higher tariff environment. Things are going to cost more. And I know we'll settle into it, but everybody has just so much in terms of funds to play around with. So do you worry about stagflation? What do you worry about in terms of the economic scenario?
I do worry about stagflation because it's probably one of the most difficult things to get out of. And that's without a lot of pain being inflicted on someone somewhere. So policy-wise, what does the Fed do with stagflation? They probably can't lower rates, right? Because that will just send inflation higher. On the other hand, if the economy is weakening and unemployment is rising, they really should be easing policy because that's part of their dual mandate. It's not an easy process to work out of. We had it in the 70s, Arthur Burns and Nixon and all that.
We've talked about it a lot here.
And it was a long, painful process to get out of it. And so if we go back to an environment like that, and particularly if we do it globally, that is going to be a very difficult process.
Is the risk now of that greater than at any point you've seen before in the last, let's say, since the great financial crisis?
Yeah, I think it is.
On a global perspective or just for the U.S.?
Globally as well. Now we're encouraging Germany and Europe to spend more on defense. I don't know that that's going to create for Europe, this boom, this fiscal boom, but it's more than we have asked of them before, and it's more spending than they've done before. So we have that in Europe. Japan has its own unique set of problems, and you've seen those yields move up very quickly. So it could become a global phenomenon.
All right, so there's that backdrop. Keep hitting my mic, they're going to yell at me. But we have that backdrop. The other thing is, nothing is as deep and liquid as the U.S. Treasury market. So how does that insulate us from some of what might come?
Yeah, I think the thing that gives me the most comfort is that there's no real replacement for the U.S. Treasury market. And the other thing is...
And not likely to be anytime soon, right?
You can't really see it on the horizon. And the other thing is we're a wealthy country with tremendous assets. So we have the capability of funding our debt, of spending, where we need to spend. We have the capability to reduce our debt and to service our debt even at higher interest rates. We don't seem to have the willingness to deal with it. That's more of the issue. But we're not like an emerging market country, a poor country that builds up so much debt it can't service the debt. We have the ability to do it.
Just a minute left. I've been asking everybody this question today when it comes to fixed income. How do you see corporates competing with fixed income right now for money?
There's been a lot of interest in investment-grade corporates. I think they're a little expensive right now.
Okay.
We like them, but, the spreads are pretty tight. So I'd say up in credit quality, but I think they look pretty good.
Yeah, because we spoke to Sandy Villery yesterday, who mentioned he's not interested on the fixed income side when it comes to U.S. debt. He's looking at corporates. That's what's interesting to him.
A lot of issuance in euro now from U.S. corporations.
Is that where you would look overseas? Like where would you in the fixed income commit some new money right now? Got about 40 seconds.
Yeah, we like, municipal bonds look very attractive. We do like investment-grade corporates, and some of the euro-denominated issues could be very attractive, even though the yield's a bit lower, if you think the dollar's going to go down as we do.
You're someone who's seen market cycles. Does this kind of feel odd, weird? Like, how do you see it? Forgive me, just got about 25 seconds.
Yes, it feels weirder than anything, and I've been in this business for almost 40 years.
Yeah.
This feels weirder than anything that I've seen.
And that includes GFC, COVID, other...
You got it.
Yeah.
Yeah.
Thank you, which is why we really looked forward to talking with you today. As always, Kathy, thank you. Kathy Jones, she's Chief Fixed Income Strategist over at Schwab Center for Financial Research, joining us right here in our Bloomberg Interactive Broker Studio. We're counting you down to the close, folks. We've just got about 10 minutes to go. This is Bloomberg Business Week Daily.
This is Bloomberg Business Week Daily with Carol Masser and Tim Stenovec on Bloomberg Radio.
All right, Carol Masser. Is everything working properly? She's testing. 1, 2, 3. Is it working?
You know, I got to plug in, plug out, pull this, do this.
You're so much more diligent than I am. I never test it.
I do.
And then if it doesn't work, I'm like, well, it doesn't work.
My father is an engineer.
Okay.
I can't even tell you the redundant systems we had growing up, whether it was flashlights or different things. Like that was his thinking. Like, what's the redundant system, or checking to make sure things work. So it's kind of where I come from.
Do you have a go bag?
No, I don't have a.
You don't have a go bag?
I don't have a go bag.
Do you know
what my go bag would look like if I had a go bag?
Your go bag would not be a carry-on. Let's just say that.
It would be like all these creams and
it would be like one of those
and different shoes.
Those like in the Titanic when they would have like the steamer trunks.
The trunks.
Yeah, that would be your go bag.
I have a trunk.
There it is. She has a trunk, ladies and gentlemen.
All right, what do you want to talk about?
I want to talk about Harvard. This is the most read story in the last 8 hours.
I am still just like, whoa.
The Trump administration told Harvard University it cannot enroll international students. It's a major blow to the school after the government froze billions of dollars of federal funding and escalating its fight with elite colleges to unprecedented levels.
Yeah, so here's what they did. The United States revoking Harvard's Student and Exchange Visitor Program certification, meaning the school can no longer enroll foreign students. Existing international students are also infected. They must transfer or lose their legal status. Again, this is coming in a statement from the Department of Homeland Security. That's where this is coming from.
Here's what the Department of Homeland Security said, quote, Harvard's leadership has created an unsafe campus environment by permitting anti-American, pro-terrorist agitators to harass and physically assault individuals, including many Jewish students, and otherwise obstruct its once venerable learning environment. The department also accused Harvard's leadership of coordinating with the Chinese Communist Party.
I think there's a lot of questions that come up, and I think we're in this environment of where do states get to call the shots? Where do institutions get to call the shots? And we've been certainly a society where there's the rule of law, there's laws, there's, regulations and so on and so forth, but there's a lot of leeway, I feel like, in terms of how institutions are run. And I am very curious to see, one would expect, as we heard earlier from our own reporter, that this will go to the courts and kind of how this plays out and how far up it goes in the courts. We'll have to wait and see.
Well, Harvard, for its part, out with a statement saying, quote, we are fully committed to maintaining Harvard's ability to host international students and scholars who hail from more than 140 countries and enrich the university and this nation immeasurably. We are working quickly to provide guidance and support to members of our community. I can't help but think of the president's inner circle and some prominent supporters of the president who weren't necessarily born in the United States, but were educated at American universities. People such as David Sachs, who's the AI and crypto czar, who went to Stanford, is South African. People such as Elon Musk, who came to the United States through Canada, I believe, during university.
This has been such a channel that we know that many people from outside the United States have wanted to come because of the educational institutions that are here in America and the level of education. And so, first of all, it's a big revenue stream, certainly for institutions. It's also, many would argue that it's kind of what this country is all about, in that bringing people in. Think about the CEOs are folks that have studied at universities and then have come in and created incredible companies that provide economic might here in the United States, create wealth, a lot of wealth for many individuals.
And to clarify, David Sachs came to the U.S. when he was 5, but still born in another country. Don't know what year he became a U.S. citizen, but Elon Musk certainly came to the United States for university from South Africa.
Yeah, I think there's going to be a lot. Listen, we're going to be writing a lot about it. I'm sure a lot of other news organizations, but it does speak to, I think, the independence of institutions in terms of how they are run, and we'll see what the legal recourse ultimately shows. All right, folks, we're counting you down to the closing bell. We've got about 2.5 minutes to go. We are looking at stocks take a leg down as we get into the final few minutes of trading. We're down now just about 3 on the S&P, still up about 33 on the NASDAQ 100, but definitely off our best levels of the session. Over to our TV colleagues. The closing bell starts right now.
Breakdown of all of today's market action starting right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic here with Scarlett Fu, taking you through to the closing bell with a global simulcast. And it starts right now. Carol Massar and Tim Stenovic in the radio booth as we welcome our audiences across all of our Bloomberg platforms, television, radio, our partnership here with YouTube. A relatively low volume day, Carol Massar.
Yeah.
We had a strong rally going, but we should point out some significant selling pressure here as we get towards those closing bells.
Yeah, we were just noting as we were coming over to you guys, right? Seeing some selling here into the close. You look at the charts and it's really kind of a rollover, if you will. You look at the VIX, though, it's something that has been up more than a point, down more than a point. Right now we're down about half a point. So the VIX, too, having a very volatile day. I think the investors are just a little kind of worried about what comes next, maybe.
Yeah, you see it on the chart right there. In fact, the S&P 500 moving between gains and losses about half a dozen times today, really searching for direction until about 1:30. That's when it was solidly in the green just until the last couple of minutes. Don't know exactly what happened, but seeing some selling into the close.
It definitely feels like we're meandering a bit, and the fact that there hasn't been a whole lot of real hard economic data this week might contribute to that. I mean, we also had a week in which we had the 20-year bond auction really have an impact on sentiment yesterday. The 10-year TIPS auction was today. What does it say that when we're so keyed into every single bond auction? It means people are looking for any kind of indication of demand for the full faith and credit of the U.S.
When was the last time you paid attention to a 20-year bond auction?
I know, right?
And then even that TIPS auction, I'm glad you brought that up because I paid close attention to that, something I normally wouldn't. Luckily, that did come in on the nose, but definitely the jitters are still there. As we get the closing bells here in New York City, we do just want to reiterate here, the S&P 500 at one point was up about 0.6% on the day, but it looks like it's going to close out in the red. We should point out, day 4 of this week right now, and the S&P has opened in the red on all 4 of those days. Now, it did close in the green on Monday, but that was it. Tuesday, Wednesday, and now Thursday, the S&P 500 lower by only about a less than 1/10%. The Dow Jones unchanged on the day. The NASDAQ, Scarlett, holding on to its gains, but only of about 0.3%, and the Russell 2000 lower by about less than 1/10%.
All right, I have some breaking earnings here. We've got it from Intuit, which is, of course, the maker of TurboTax. The software company reporting third quarter adjusted EPS of $1.65, handily beating the consensus estimate of under $11. It also has raised its full year guidance as well, now looking for a full year revenue of $18.72 billion to $18.76 billion. Previously, it had anticipated only as much as $18.35 billion. It sees full year adjusted operating income of up to $7.56 billion. Previously, I should say the consensus estimate is $7.32 billion. So you're looking at a boost here in the outlook, which is always encouraging for investors. And we should note, by the way, that the third quarter is the biggest quarter of the year for Intuit because it wraps in April 15th, tax day, when people buy TurboTax.
Yes, indeed. It makes a lot of sense. Hey, some more earnings coming. Ross Stores just crossing the Bloomberg terminal. First quarter results, EPS $1.47. That's a penny better than what the street was expecting. Actually, 2 pennies better than what the street was expecting. It's a penny better than the year before. Sales coming in at $4.98 billion. That's up 2.6% year over year. Estimate on the street was a little bit below that, $496. Inventories, $2.67 billion. That's up 8.5% year over year. The estimate was for $2.56 billion. So maybe a little bit of an inventory build. We do have the company's CEO saying, despite the slower start to the spring selling season in February, our monthly sales performance improved sharply month after month for the balance of the quarter. So certainly a read on consumers right now. The stock, though, guys, it is unchanged in the aftermarket.
Autodesk out with their results, of course, enterprise software company with a big focus on architectural firms. Adjusted EPS of $2.29 a share. That's higher than street estimates of about $2.15 a share. A beat on revenue as well. And here's your forecast. The company is saying that for 2026, the full year, its full fiscal year of 2026, it sees billings in the range of $7.16 to $7.31 billion, the low end of that range, above the average of street estimates. Adjusted EPS for the year, it says, will be in the range of $9.50 to $9.73 a share. The top end of that range is above the average of analyst estimates. The shares higher by about 1.8% right now.
I'm looking at what's going on with Workday in the after hours. This is the enterprise software company focused on HR and the like. Shares bouncing around, down by about 2.6% right now. The company did see first quarter adjusted earnings per share beat estimates. The company sees fiscal year subscription revenue maintaining at $8.8 billion, sees second quarter subscription revenue coming in at $2.16 billion. That matched estimates. The company does see fiscal year adjusted operating margin at 28.5%. Earlier, it saw 28%, so that's a beat there. Estimates were at 28.1%. The company still, as I mentioned, sees fiscal year subscription revenue coming in at $8.8 billion. Shares right now in the after hours bouncing around, but down about 2.6%.
Hey, guys, I want to go back to Ross Stores because we saw this stock down about now 5.4% here in the aftermarket. A little bit more commentary from the company saying, given the varying nature of tariff announcements, we are only providing an outlook for the second quarter at this time and are withdrawing our previously provided annual sales and earnings guidance. So when we think about tariffs and whether or not companies feel like they have visibility, certain for a retailer who gets so much merchandise overseas, we can certainly see that that's having an impact. And so you've got Ross Stores down almost 7% here in the aftermarket. All right, that one is down. Let me go to some of the gainers in the regular session. Palantir is on that list. At its highs today, up almost 5%. It was a top gainer in both the S&P 500 and the NASDAQ 100, finishing the day with a gain of about 1.3%. Dow Jones Barron's out reporting on the company, noting that the U.S. Defense Department, said late yesterday after the close that it had raised the contract ceiling for a program that Palantir provides. It's their Maven Smart Systems software licensees by $795 million. So basically they're saying, and analysts are noting, that Palantir stands to win from these deepening ties to the Defense Department. So this one's been on a tear this year. It's up about 65%. Advanced Auto Parts, way out performance today, up about 57%. The company reporting comp sales that fell less than expected in the first quarter, also saying that it's reaffirming their annual sales guidance, or annual guidance, based on performance to date. The guidance assuming current tariffs remain in place for the remainder of 2025, but really some outperformance there. And Urban Outfitter also up about 23%, so a big move to the upside. The company reported net sales for the first quarter that beat the average analyst estimates, and analysts noting the strength in its namesake UO brand and are positive about the retailer's margin expansion. Stock now up more than 30% year to date. Scarlett, over to you.
All right, we have Deckers reporting results. This is the company behind Uggs and Teva sandals. They're withdrawing their full year guidance, or I should say not providing full year guidance for fiscal year 2026 because of the macroeconomic uncertainty related to evolving global trade policy. So you see that stock down about 7% in after hours trading. As for the quarter that was, for the fourth quarter, they reported net sales of $1.02 billion, just slightly higher than what analysts were looking for, which was $1 billion. And the EPS for the fourth quarter was $1 a share. But once again, that's backwards looking. Deckers is not providing a guidance outlook for this full year, but it does say it's capable of returning value to shareholders. Talks about the $1.9 billion of cash on hand, sustainable cash flow generation, and the increased buyback program, which now totals $2.5 billion.
All right, more retail news coming from Deckers. Shares down about 10% in the after hours. Other retailers moving today. Williams-Sonoma shares falling 4.5%. Shares were down as much as 12% earlier in the session. Wall Street questioned the company's reaffirming full year net revenue guidance given its significant first quarter beat. Once again, shares down by 4.5% today. Also, I'm looking at the Invesco Solar ETF. Solar stocks did so poorly today that I had to look at the entire ETF. We saw a lot of names move lower in the double digits. As a whole, though, this ETF fell about 7.5%. It tracks the MAC Global Solar Energy Index. The biggest holdings include First Solar, Enphase Energy, and Sunrun. Stocks fell as U.S. House Republicans' new version of the tax and spending bill accelerates the end of incentives for clean energy production. Taking a look at what actually fell in there: Sunrun down 37%, Solar Edge Technologies down 25%, Enphase Energy down 19.6% today. And finally, for the sports fans out there, Manchester United down 8.6% today. It's after we got some news about, well, just how they did, Romain.
Yeah, they didn't do well.
That's not good.
Which always seemed odd to me. You know, you lose and, somehow your stock goes down. Let's go take a quick look at yield. So, and these numbers really don't tell the whole story. Right now, you're looking at a 30-year yield moving lower on the day by about 4 basis points. But all the action was early this morning here, where we saw yields spike about 6 basis points on the long end of the curve to 5.15 on that 30-year. And that is where most of the action was. I thought Greg Peters over at PGIM Fixed Income really put it well here. There's there's really two bond markets out there right now. You have all the crowding going on right now in the short end of the curve, and on the long end, it's anybody's guess, because right now the tail is wagging the dog out of Washington right now with those budget bills and what it may add potentially to the deficit.
Yep, we're all focused on Washington, no doubt about it. All right, that's a wrap. Our cross-platform coverage, radio, TV, YouTube, Bloomberg Originals. Alex is heading out. Scarlett and Romaine finishing up there on television. Tim and I coming back to Bloomberg Business Week Daily right here on radio. Guys, we will see you again, same time, same place tomorrow.
This is Bloomberg Business Week Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Business Week Daily with Carol Masser and Tim Stenivek, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
Coming up next, it's not coming up next. We're doing this now, Carol? Are we doing this now? Oh my gosh.
Listen,
that's Carol Masser. I'm Tim Stenivek.
To be fair, that was a big drop of earnings, a lot of stuff. And I think some interesting thing, especially when it comes to the retailers, some of those, like Deckers, basically not providing full year guidance due to macro uncertainty. Stock's down 7%.
And then you mentioned something similar when it comes to Ross stores, right?
Yeah.
With their guidance.
Exactly. So it's like, these companies are feeling it. They're going to see it. Yeah.
Look, we'll have Gina Martin Adams back soon because she said to watch earnings closely. We're getting the wrap of retail earnings right now. It's really. This is like a mixed bag if I've ever seen a mixed bag.
Absolutely.
On the one hand, you had Walmart out there. It was a different story than Target. And then you have the discount retailers such as Ross stores coming out. You got Deckers Brands, which has Hoka, Teva, UGG. They're worried about their guidance.
Down 9.6% as we speak. Ross stores down about 7.4%. All right, we're going to keep watching these stocks in the aftermarket. In the meantime, one of the stories that really caught our attention this morning on our read-in, and we wanted to bring it to you, is about Texas regulators who are warning that wastewater from fracking in the biggest U.S. oil basin is causing a widespread increase in underground pressure. So it's a development that basically risks hindering crude output and harming the environment. So there's a lot going on here. David Wethy is Bloomberg News energy reporter and kindly joining us from our Houston bureau to tell us a little bit more about what's going on. David, fill us in and give us some context and perspective about how big this oil basin and why it is so important, especially in a context where I think we're looking at things like rare earths, raw materials, commodities as being important to national security.
Yeah, you hit it on the head. This is becoming a way more important area of the country and very important for the oil industry. So it's the world's biggest shale basin, shale being tight rock, and it accounts for roughly half of the U.S. oil production. So it's become very important for the U.S. oil industry. But with all the oil that comes out of this rock, there's a lot of water that comes out as well, and actually way more water than oil, about roughly 4 barrels of water for every 1 barrel of oil. So if we're doing really good in oil production, we're doing unbelievable in water production. But the problem is this is very, very, very salty water, even saltier than the ocean. So you can't do anything with it. You can't drink it. You can't use it for crops or anything. You can't even just dump it on the ground. So the most cost-effective way that they've been doing for the longest time, for years and years and years, is just to dispose of it back underground. But the problem is, as we start to develop more oil and develop more water, you're running out of places to put it, basically. And so it has been causing earthquakes, and we've been writing about that. That was maybe 5-7 years ago.
Yeah.
And it was becoming a very important problem up until 2022. Then they start to make the pivot and say, okay, let's not dispose of it so deeply anymore. Let's now put it in shallow spaces. But the problem is the shallow spaces is now it's creating so much pressure that it's running into old oil well bores that are no longer producing anymore, and it's now causing geysers, the salty water to shoot up into the air because there's just so much, and it's become a systemic problem within the region, and the regulator is just now trying to get his arms around it.
Okay, forgive me, but I'm not somebody who is totally read in on exactly how hydraulic fracturing works. So please take us through it, David, for the layperson. Water is in the name. It's, you
need water to do
hydraulic
this.
fracturing. There's
a lot of water.
You need a lot of water. Where do they get that water? How does it get so salty? How does it get so toxic? And then what traditionally have they done with it?
Sure. So 2 things. Number one, there's water already just naturally underground in the rock, commingled with the oil and the natural gas. So when we go and drill and we want to get oil or we want to get natural gas, unfortunately, we also just get natural water that comes out of it. But it's very, very salty just as it lies in the rock, because oceans were there, you know, many, long time ago. And so that naturally producing water is coming up. But in addition to it, also the water that we used for the frack job. So we had been getting fresh water, nice, clean, pure water that we would source from elsewhere. And we'd use that for the frack jobs. But now we're trying to be more conscious of not using up so much of the fresh water anymore, that we're trying to use some of that water that's coming out with the oil. And we're trying to say, let's use this enormous amount of water and recycle it and put it back into the next frack job. Basically, when you frack, you're using a bunch of trucks of water and you're mixing it with chemicals and sand. So water, sand, and chemicals, you're blasting that underground to crack the rock open into a spider web of cracks. That's how the oil comes out. And you use the sand to prop open the cracks, and you use the chemicals to kill, you know, naturally occurring, you know, living organisms in that water. So that's the chemicals. But all that stuff just comes out in this big slurry of oil, natural gas, and chemical-laced water. So that's why you've got this really, really dirty, toxic, poisonous water that you must basically either put back down just into a different reservoir entirely, where it just sits there permanently, or you try to recycle some of that. You can only recycle so much for the frack job.
You know, David, it just makes me, you know, there's no free lunch with any of this. And I think about the coal mining in West Virginia and like the mines and the mountains that are just shaved off, right? And they're just left there. And, you know, that's what it is. And there's environmental impact. Did they not know? They've been doing this for a long time. I remember going up to the Bakken in 2011 or 2010 to see what was going up in North Dakota.
Those were boom times, right?
Boom time. Crazy, crazy, crazy boom time. I mean, it was frenetic. And the locals were like, yep, we've seen this before. We'll have a boom and then we'll have a bust. But having said that, this has been going on for a long time. Did we not understand that there would be impacts and something like the water running off and potentially, you know, impacting the water tables?
Not to this level. And I think one of the things is that you have to have you just sort of have to be in the right spot at the right time to where that part of the country, that particular kind of rock, could be either triggered by the earthquakes. You have to have the faults in a certain area where it could be triggered by the earthquakes. And then you have to have a lot of water to be able to build up this kind of pressure as well, to then have these leaks more on the shallow side of things. So I think this is just part of the growing pains of shale becoming so big and what it is. We never quite had this large amount of production before from any one basin. So you never quite ran into this problem to know that this would be a problem. And so they're sort of figuring this out on the fly.
So what happens? Because if we have to like change the process, clean the water, do something, that to me sounds like added costs. And so if you're an oil company, energy company, driller, whatever, you're doing this, you're going to be like, maybe it just doesn't make sense as much. The cost equation changes. So play this out for me. What might we expect here?
Sure, and that's what we're going to go into for a part 2 of our series coming up later on in the future. But basically, a couple things they're doing right now is they're building longer water pipelines to send the water further away to less pressure built up areas. So you're starting to see that happen right now. That's a sort of a easier, quicker fix. A longer term solution is they're working on trying to clean the water to a little bit more of a safer level, not quite for consumption for humans, but to at least put down on the ground for non-consumable agricultural products. Think like cotton, which grows a lot out in West Texas. So you're trying to at least clean it up to that kind of standard, but you're trying to clean it up to the lowest cost possible, so you're not adding on a ton more costs. So that's why oil companies are watching what the oil price is right now. Is it at $60? You still have to pay out your dividends to shareholders and all that. So if you're starting to add on costs of cleaning the water, that all starts to affect how much you're trying to produce. We don't quite have this sense that it's going to simply shut down production, but it is going to add to the cost. Now, one other thing to keep in mind, though, is we just heard from Coterra Energy on their earnings call most recently talk about how some of their brand new production was being impacted by water leaking out and starting to affect their production. So that's something more to watch.
Keep keep on our radar, right? Because it could certainly impact things. David Wethy, thank you so much. You took us there. Another place around the country, stuff going on that needs to be brought to the attention of certainly our audience and to investors. David Wethy, he's Bloomberg News energy reporter. Check out his story. You can find it on the Bloomberg and also at Bloomberg.com.
Coming up next, a tariff-free menu of policies that offer a sure path to revitalizing U.S. manufacturing. That's next.
It's 421 on Wall Street. We do check markets all day long here at Bloomberg, and this Bloomberg Business Flash is brought to you by Oracle. Attention growing businesses. Oracle is offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure. For new U.S. customers with minimum financial commitments, see if your company qualifies at oracle.com/Bloomberg. Lots of earnings after the close of trading. Just heard from Intuit, posted strong revenue growth following the end of the U.S. tax season, suggesting the financial software company is finding success offering users more expensive services. After hours, Intuit up now by just about 8%. Workday approved a $1 billion share repurchase program, down after hours by roughly 6%. An Autodesk boosted its billing guidance for the year. Autodesk right now up by 5.3%. S&P lower by 2 points, down less than 0.1%. The Dow dropped 1 point today. NASDAQ held on to a 53-point gain, up 0.3%. 1%. 10-year 4.53%, the 2-year 3.98%, with a 30-year at 5.04%. Gold down $23 the ounce, down 0.7%. West Texas Intermediate crude down 1.3% at $60.78 a barrel. A record today for Bitcoin, 111,177 now on Bitcoin, up 2.7%. Hinge Health and Mountain, MNTN on the ticker, both gained during their first day of trading after pricing at the high end of the range. Hinge up today by 17.4%, and Mountain, that is the connected TV ad platform, up by 64.7%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Hey, thanks for that update, Charlie. Do appreciate it. I want to talk about American manufacturing because back ahead of the financial crisis, the sector's workforce was about 1 million people stronger.
Got it.
It's never recovered
Nope.
since then. But as Dan Wang, a research fellow at Stanford University's Hoover History Lab, and Ben Reinhardt, the CEO of the nonprofit Industrial Research Lab Speculative Technologies, write, in the June issue of Bloomberg Businessweek magazine, American industry has certainly seen better days. They argue, though, that tariffs are not the solution to revitalizing the sector. Ben Reinhardt joins us now in the Bloomberg Interactive Brokers studio. Ben, you have a tariff-free menu of policies that offer a sure path to revitalizing U.S. manufacturing, you and Dan, right? Before we get there, explain for everybody what an industrial research lab is.
Well, so I like to describe it as we're a research lab in the sense that we are working on trying to create new technologies. We're not working on products, but at the same time, we're trying to do research that is not just trying to discover the secrets of the universe, but really build useful technologies. So that's sort of the line I like to think that we're walking, where it's like we're doing stuff that doesn't make sense yet as a company. I wouldn't go to an investor and say you can make a bunch of money, but we are nevertheless like trying to do things that eventually will become useful. So think Bell Labs, Xerox PARC, that sort of work.
Very cool. So sort of a Skunk Works type of thing.
Exactly.
Pre-product. Okay. You and Dan have been thinking a lot about tariffs and the way that the president has been trying to revitalize American manufacturing. His love for tariffs is no secret. We've known about it for many, many decades, but I think perhaps it caught some investors off guard back in April when he announced the reciprocal tariffs on so-called Liberation Day. You argue that there are better ways to revive manufacturing in the U.S. You say we should look at what China has done.
Yeah, so there are two things in particular that they've done. So they've done many things. Some of them we don't think that we should copy, but there are two in particular that I think are particularly worth looking at. One of them is inviting in foreign investment. Right, so actually, one of the ways that they built up their manufacturing is by inviting in foreign companies and getting them to build factories there. And sort of, regardless of your position on stealing technology, you still build up a workforce that knows how to build those things and then can go and build that technology. So you can imagine inviting in Chinese companies even who have now technologies that we don't have, and you then build up a workforce who knows how to, say, make batteries. So that's one. Two is like industrial zones, right? So you're the most well known is Shenzhen, but there are many others where to a large extent the government took a very hands-off approach and just said okay, within this zone you can basically do whatever you want. There's a lot of nuance to that, but right now it is extremely hard to build new factories.
I do want to push back a little bit on this. My one experience in China back in 2019, before the pandemic, I went to Shanghai. I know it's a completely different place now, but one thing that struck me was when the plane landed, I looked out the window and it was what I thought was the thickest fog. It turned out it was pollution. My throat was sore the entire time I was there. We couldn't see out of our hotel room windows because we were on the 15th floor and the air was too clogged with pollution as a result of some of the industrialization that we're talking about here. Do we really want that in the U.S.?
I don't think it's an either or sort of thing. A lot of modern manufacturing technologies no longer produce that sort of waste. And a lot of the manufacturing that we're talking about doesn't do that. And there are many technologies for cleaning that up. So you were seeing sort of the result of manufacturing technologies from like the 50s and 60s. And so we're saying like, okay, we're going to build technologies of the 21st century, which have many fewer side effects.
Ben, I got to say what's really cool is our Steve Mann of our Bloomberg Intelligence team and covers the auto sector. And one of the things he has said recently to us, because as we think about tariffs and bringing manufacturing back home, he said one thing that China learned, I mean, by doing all that manufacturing, they actually developed some very sophisticated technology that is now helping them to kind of operate on a higher plane, and whether it's develop car, like whatever have you. And I never thought about that. I guess I thought about bringing manufacturing back home. Do we really want to be making T-shirts and sneakers? But that's not what it's about. It's about they've become very sophisticated with technology because of the automation and all of the manufacturing they've been doing.
Oh, yeah. Couldn't agree more. Manufacturing and new technology and research really go hand in hand. You can't have one without another. Honestly, that's one of the reasons why I'm such a big proponent of manufacturing.
But I don't think we always put that together.
Yeah. It's like the best technologies, the best research comes from noticing a problem in an actual manufacturing line, right? Like going back to us being an industrial research lab, the point is to notice, oh, there's this actual real problem in the world and we need to do research to fix it.
I think it's pretty wild. So is President Trump right in terms of encouraging companies outside the United States, even American companies, to start investing more here?
Along that axis, yes. I think I will not unequivocally agree with everything.
But in encouraging foreign, and as many have said to us, you know, there are commitments, and then you'll see whether or not those commitments, which are often multi-year commitments, and also you can't just build a factory overnight, right, or a facility, but we'll see over time whether or not this actually happens.
Yeah, I think so. I think that it would ideally be done with carrots and not sticks. But yes, I think that
the message, right, but maybe not the mode.
Yeah, exactly.
Is at least your view. Yeah.
Okay, so that's one way to be thinking about this. Study China. I want to talk a little bit about some other solutions that you have. Preserving the strengths that America already has. Talk a little bit about what you mean by that.
Yeah, so, you know, America has a lot of strengths that I feel like literally today we are sort of throwing away, right? Like we have this amazing ability to attract talent from all over the world, and
if the universities let them in.
Yeah, exactly. And the universities and immigration, right? Like, so historically.
In all seriousness, I'm not bringing that up facetiously. I'm saying that is at risk right now, given the different rules that we've seen.
Oh yeah, exactly. And so our point is like, don't stop. Like that is really, and that is a unique strength of ours, right? Like China doesn't attract global talent in the same way that we do. And again, in our university and research system, also, you know, you've seen the cuts to NSF and NIH and NASA, and the list goes on. And you know, our research ecosystem is the envy of the world, and we should, you know, keep that the case.
What do you say to folks who say, listen, okay, you've got something like an Ivy League that has an incredibly large endowment. So why does the government, U.S. government, need to give them money to do R&D? So what's the argument to that? Why, you know, or if you're going to give it to maybe another organization that needs it more? Like, what's the argument for continuing for federal money to go to some of these massive, well-known institutions, academic institutions?
Yeah, so there's a lot of nuance that we can't get into here. I think that they're like rethinking where the money, like where government R&D money goes.
Yeah,
definitely another conversation for another time. But just like as things stand now, like the money should go to the best researchers. Like the best research is going to come from the best research. Research is like very much a power law distributed thing. Mm-hmm. And for better or for worse, the best researchers are at places like Harvard. And so that would be my argument for it.
Ben, what do you see the risks to U.S. manufacturing or to the U.S. economy if the United States continues with this tariff program?
I mean, I see just like U.S. manufacturing, like it's not going to necessarily make manufacturing better, right? Like I don't think it's actually going to achieve the aims. You see because so many of the parts that manufacturers depend on are coming from overseas and are being heavily tariffed, and so like you're already seeing like manufacturers of CNC machines getting completely hosed by the tariffs, and so I just see like manufacturing as an industry being directly hurt by it, let alone not helped.
Yeah, I think it's kind of, who knows where this goes, right, ultimately. But I think, like, understanding the impact that immigrants or immigration and bringing folks in from other countries, whether it's in high-skilled or low-skilled jobs, like, has an economic impact, right? And it pays off in many different ways, or tends to.
Absolutely. I mean, you just like, I interact with a lot of researchers. You look at who is getting STEM PhDs, who's doing research in like hard science and technology, and it's the vast majority of people are not from the U.S.
How do you think about all of this with something that is going to be obviously a big deal? And I'm thinking about artificial intelligence, and I think about DeepSeek. And when that news came out, we all were like, "Oh, China they're moving ahead."
Yeah. I think the argument is across all of it, right? Like you want, like ideally, it would be great for some of the people who developed DeepSeek to want to come to the U.S. and do work here.
Right.
And again, you look at who is actually working at these AI companies, and there's people from all across the world. Like I have friends there. And like people who came up with a lot of the algorithms that the U.S. AI companies are using are not American. And so again, this is just like example after example of our strength is our ability to pull in these talented people.
30 seconds. Are you optimistic or pessimistic that some of this stuff will be adopted?
I am pessimistic, but I am optimistic that can change.
But if we don't get this right, big deal.
Big deal.
Meaning the U.S. economy, meaning U.S. role in the world, or what?
Yeah, I think all of the above. I think that you could really see us, like honestly, on some kind of decline, some kind of like becoming like Ming China or Japan after they close themselves off.
We're gonna leave it on that though. I'm sure we'll come back to you.
Definitely.
Certainly something to get us all thinking. Ben Reinhardt, he's Bloomberg Businessweek contributing writer and CEO of Speculative Technologies. This is Bloomberg.
4:40 on Wall Street. We do check markets all day long here at Bloomberg. The Dow, the S&P, both lower today. NASDAQ held on to a 53-point gain, up 0.3%. Late day fade, though. Wall Street struggled to make a comeback in the wake of a Treasury sell-off that shook global markets amid fiscal concerns. Stocks wiping out those gains in the last stretch of U.S. trading. Bonds and the dollar rose. S&P 500 index today down 2 points. Little change there. The Dow was down 1 point. NASDAQ up 53, a gain of 0.3%. 10-year 4.52% with a 2-year 3.98%. Gold at spot gold today did move lower, down $22 the ounce. 32.93, drop there of 0.7%. And West Texas Intermediate crude down 1.3%, 60.80 a barrel on WTI. Bitcoin just below $111,000. Bitcoin today at a record up 2.5%. Kathy Jones is Chief Fixed Income Strategist at the Schwab Center for Financial Research. And right here on Bloomberg Business Week Daily, we spoke with her about the outlook for yields.
If nothing changes on the policy front, the likelihood is that yields will continue to rise at the long end, just because investors want more compensation for all the risks that have been, put together here.
Kathy Jones, Chief Fixed Income Strategy at the Schwab Center for Financial Research, interviewed right here on Bloomberg Business Week Daily. Again, the 10-year, 4.52%, the 2-year, 3.98%, the 30-year, 5.04%. For on-demand news, 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. As we mentioned, it's a pretty busy Thursday. We do have another headline crossing the Bloomberg terminal. This has to do with the U.S. Supreme Court backing President Trump's ouster of agency leaders for now. We know that the president has removed some folks from various divisions within the government. So again, right now, we've got the U.S. Supreme Court backing those moves by the president. We'll continue to report that out for you and bring you any more headlines as they are known.
Well, you guys all know. Everybody knows we love talking GLP-1s and weight loss medications. The market, some forecasts suggest it could reach $130 billion by 2030. So yeah, Carol, there is some real money here. We've got Dr. Mitchell Steiner with us. He's an MD, urologist. He's chairman, president, and CEO of Veru. It's a Miami-based microcap. Market cap's around $72 billion. The stock down so far this year by about 25%. He joins us here in the Bloomberg Interactive Brokers studio. What did I say? Did I say 72 billion? I did, and I have a typo. 72 million, excuse me. Thank you for keeping me honest, Carol Nassar.
Something happened.
Today's trade.
There's something I didn't know.
Which, by the way, would you still be here with us today?
No, I was about to walk out.
Yes. He's got a vacation to go on. Doctor, welcome. Thanks for joining us. You know, you guys are known as an oncology, a urology biopharmaceutical company, but right now you're working on a companion medication to weight loss. Explain exactly what you're doing here.
Yeah, we made a hard pivot about a year and a half ago because we have a compound called the Enobosarm. So think of it as a testosterone mimetic. So it's like testosterone, but it doesn't have the same side effects. So you don't get masculinization in women. You don't affect the prostate in men. So women can actually take it and see the benefits of holding on to muscle and burning fat. So we were actually developing it for breast cancer.
Right.
And so we're an oncology company, and people were telling Mitch, you know, this GLP-1 craze, I mean, can you believe it? That you lose all this weight, and half of that weight is lean muscle? So if you lose 20 pounds, half of it is muscle, and people are starting to freak out. They're starting to get the Ozempic.
I see it. I see it in individuals who take it. Yeah. Well, I actually see it in their legs. Like they're losing muscle. It's like unbelievable.
And the patient population is most at risk of patients over the age of 60 because they don't have much muscle reserve to begin with. Right. They could be obese. So on the outside, they look jolly and they look big, but from the inside, they have very, very little muscle. So since we had an agent that did that, we said, you know what? The problem is that right now these fat loss medicines are not getting rid of just fat. They're getting rid of fat and muscle. So that's not what's the intention. The dangerous tissue is fat, not muscle.
So your drug does it differently, or what you guys are working on?
So what our drug does, holds on to muscle, burns fat. So if you give it as a companion with a GLP-1 that burns fat and muscle, the idea is can you convert the GLP-1 from an indiscriminate loss of fat and muscle? That's what happens in the wild. Your appetite gets suppressed, you lose muscle and fat. So if we can switch that and tell muscle, don't burn, tell fat to burn more fat so you get to the same weight loss, then you're going to have a fat-burning compound, which is what a weight loss drug should be. It should be to get rid of fat. The FDA even said it. The FDA says obesity drug, it gets rid of fat, not muscle. When you look at Arnold Schwarzenegger, when he was muscular, you don't say, oh, that guy's fat.
So you guys are in late-stage clinical, right?
So we're in
Where are you?
phase 2B, mid-stage.
Phase 2.
Late mid-stage. And we actually have the results. So what I'm telling you, it's not what we think it's going to do, what it has shown to do. So we use Wegovy, which is one of the two major ones. And Wegovy causes about 60% of the weight we lost is fat and 40% is lean.
Okay.
We were able to convert that to 99% fat and 1% lean at 16 weeks.
How effective is it, though?
Well, that's what I'm telling you. That's the
No. I understand it's losing more fat, but how much weight loss is done?
So the weight loss is the same. So imagine now you have a situation where you can hold on to your lean, and you can get to the same weight loss. The only way that can happen is you have to lose more fat.
It seems like you'd be a ripe target for an acquisition by an Eli Lilly or a Novo Nordisk.
Yes. I mean, it makes sense, right? Because all of the GLP-1 drugs have the same problem, the indiscriminate loss of tissue. And the two on the market now is Lilly, who's way ahead, and Novo Nordisk that's falling behind. They're going to be on the market for a while, and market leaders, they have that problem.
How do you anticipate, once this is fully approved, once it does hit the pharmacies, how is it administered?
So this is an oral agent, it's a pill. The reason that's important is because the future of weight loss is not going to be the injectables that you keep injecting yourself. That's why Eli Lilly's market cap went up $100 billion in one day when they reported the results of their oral GLP-1. And so, gosh, can you imagine a situation, you have an oral GLP-1 and you have an oral enobosarm, and you put them together and you make the fat burner, muscle burner, now just a fat burner.
So let me just understand, though, how yours work. And forgive me, because you're the expert, I'm not, but it's a SARM mechanism?
So it's called a SARM. That stands for Selective Androgen Receptor Modulator. There's a lot of words, but the word you want to hear is androgen. Androgen is testosterone.
Right.
So remember, I opened my comments by saying that we're a testosterone mimetic.
Well, that's what I wanted to ask you, because there's always, I feel like when it comes to hormones, whether it's testosterone, there's always some concern about what are the side effects of something like that. So what do we need to be worried about?
So this molecule, which is a small molecule, not a hormone, was purposely designed to avoid some of those side effects. So, for example, one of the side effects is for men, you can affect the prostate, you can affect hair and that kind of stuff. We're not made into that substance that does that. In women, you're worried because it can be made into estrogen.
Correct.
Women get estrogen from testosterone. So if you have a compound,
it could be really dangerous, super dangerous.
It could be very dangerous.
Yeah.
Enobosarm cannot be made into estrogen. So that's why half of the patients, we have like 2,000 patients on our database, half of them are women. In the 168 patient study we just did, 70% were women, and no report of masculinization, no blood clots, none of that stuff.
What else could this be used for apart from as an accompaniment to a GLP-1 weight loss medication?
Well, the focus should be on that, but what we're focusing on first initially is older patients because they're at risk.
So above 60, you said, because of the muscle loss.
Above 60, starting GLP-1 for the first time, that's the patient population. Once you're in that patient population, the next step is to go to all patients with obesity. Next is to go to diabetic patients on GLP-1, older patients and younger patients. And then the holy grail is to go after something called frailty. Frailty is muscle loss with aging. So you can picture in your mind what that patient looks like. And
this is why we're supposed to be lifting weights now all
that's
the time.
Important. Now, another thing that's very, very important.
No, it's really true, yeah.
Is that GLP-1s do cause physical problems in older patients. We showed that. In a 168 patient study, we showed that if you take just a GLP-1 for 16 weeks, you lose stair climb power that's equal to about 7 years of aging. So that happened in 42.6% of the patients. Wow.
So what's your envisaged safety profile?
So the safety, I'm glad you asked. We're going to be announcing this quarter the safety profile for the 168 patients that we just finished with GLP-1. We're the first company to be reporting data with GLP-1 with a muscle preservation drug. So this will be very, very interesting. We've shown the efficacy, where I just showed you that we did a 99% fat and only 1% lean being lost, and we improve physical function. But the safety is going to be coming very shortly. I can tell you that we see the aggregate safety, meaning that we don't know which group, and it doesn't look any different than what we've seen with the Enobosarm or what we've seen with the GLP-1.
Dr. Steiner, thank you so much for joining us. Dr. Mitchell Steiner, Chairman, President, and CEO of Veru.
We mentioned that Supreme Court decision upholding the president's ability to oust those agency leaders. Supreme Court says that ruling does not apply to the Federal Reserve. This is Bloomberg.
This is Bloomberg Business Week Daily with Carol Masser and Tim Stenovec on Bloomberg Radio.
All right, everybody. Just getting ready to wrap up on the Thursday edition of Bloomberg Business Week Daily. Carol Masser, Tim Stenovec live here in our Bloomberg Interactive Brokers studio. As we know, stocks ending a little change, a little bit lower.
Did you see what the Dow did? It's not red. It's not green.
What do you mean it's red?
It's orange.
It's down 1 point.
Yeah, but it's orange on my screen. Percent change. What does the percent change show you? What color is that, Carol Masser?
I don't know. I'm looking.
You don't have orange?
I have my own little custom screens.
Oh, Carol with her custom screens.
Orange.
It flashes rally when the S&P 500 is up half a percentage point.
WEI?
WEI, yeah. What is it? What color is it? Tell me.
Tim.
That stands for World Equity Index.
My WEI. No.
Okay,
flat.
it's orange. Elizabeth
It's
says it's
flat.
orange too.
It's orange. It's flat.
It's orange? It's orange? I'm just saying.
It's orange. Aren't you glad I didn't say banana?
Aren't you glad we're going to be done talking about this soon?
Knock, knock.
I just say it's not every day that it's not red and it's not green.
All right, all right.
Okay?
Carol Masser along with Tim Stenovec. Let's take a look at some stocks on the move today. Joining us is Bloomberg News equities reporter Natalia Kunijevic. She is here in our studio. Where are we starting? Wait, you've got a company that moved like a lot today.
Yeah.
It
Let's
moved.
talk about IPOs first, guys.
Oh, okay. So go.
Yeah. So
IPOs happening in this market.
Exactly.
It moved.
Moved.
It moved. Okay, sorry. Go
Really,
Go ahead.
two
Just
successful
ignore him.
stories today. We can't ignore Tim. So first one, Hinge Health. The stock is up by almost 17% after the IPO. The company raised more than $430 million. It was priced at basically raised much more than the company priced. When we spoke with sources yesterday before the company officially priced the IPO, it was oversubscribed. What was really interesting is that allocations were really skewed towards like long-only investors,
Interesting.
healthcare-focused investors. Why it is important? Less volatility, because when the lockup expires a month from now,
right.
Typically fast money like hedge funds, they sell stocks, but now if there are lots of long-only investors allocate capital, it means less volatility. Hinge Health, for viewers, listeners who don't know, this is a basically digital healthcare platform. So if you have pain in your back, you apply. They give you instructions. I used it, but I was too lazy to follow instructions.
This is why I said it moved. It's a physical therapy app. It moved. That's what we're supposed to do.
Have you used this?
You know, I
have a physical therapy app, but I don't think it's.
I don't think I've used this one before. I've used two different ones with the same physical therapist.
MedBridge?
Yeah, that's the one I've used.
That's the one I've used. I
that's
love it.
because we've gone to the same place.
I know. I love these apps. I love it. It's like little
It's pretty
people
cool.
and they're doing it.
So
and
much
it walks
better
you
than
through-
when I was a kid and it was like a Xerox copy of
and I was like,
pictures of how to do a stretch.
Yeah, I know, exactly.
Yeah, it's pretty cool.
We should say that it did sell, I'm just looking at the price, 13.7 million shares in aggregate, having offered them for 28 to 32 each.
Exactly.
A little bit of a range there, right?
Yeah. And closed at $37.
Yeah,
so really successful IPO.
Yeah, doing pretty well.
But we know that there are so many concerns because the volatile environment. But then we have another one, MNTN or Mountain. The stock is up by more than 60%. So we see that it raised almost $200 million. Priced at $16 per share, closed at $36 per share. And again, a really strong demand across long-only investors. We know that Hollywood actor Ryan Reynolds, I can never pronounce his name. Reynolds, yes, he played a big role. He's a chief creative officer.
Mr. Blake Lively. Can I even say that? Sorry, go ahead.
And then I follow this story pretty closely too.
Who doesn't, right? Come on. Welcome to Bloomberg /People News.
I have no idea what you're talking about.
Okay, go ahead.
So yes, really good demand. And again, yesterday when we spoke to some investment bankers, they were really optimistic, strong demand. People wanted to buy those stocks. So we'll see how it plays out.
Mark Douglas, the chairman, president, CEO, and founder of this company, we've spoken to him quite a bit over the last few months ahead of this IPO.
Can I just say the IPO, did you say this drew orders for orders for around 14 times the number of shares available. So talk about being certainly oversubscribed and interesting. Ryan Reynolds.
Yeah.
Maybe it's Ryan Reynolds factor. Maybe a little bit. Just a little bit.
What he touches turns to gold. That has been historically what happens.
Except for Blake Lively. She's not gold yet. She's still.
I'm talking about the business stuff. Like, didn't he do Mint Mobile too?
Let's talk about United Airlines, shall we?
Shall we? Yes. So not such a big move, 3.6%. The stock is up. However, it is a big signal for the market. So because CEO Scott Kirby told shareholders today that it sees at least stable revenue and booking environment heading into the Memorial Day and potentially start of the summer travel season. Why it's important? We remember when the company reported earnings, it issued 2 forecasts in case we have a recession. If we don't.
That's right.
Yes, and analysts really loved that scenario because unlike other companies like Delta Airlines, they just withdrew guidance. So now United is saying that, yeah, potentially we can avoid a recession, which is good. And in this case, they see earnings EPS between $11.5 and $13.5 a share. Overall, it's a pretty big move since this low in April 8th. The stock is up by 35% since early April, but still down on a year-to-date basis.
Very interesting. And I should point out, Southwest also came out. Their CFO warned of ongoing softness, and that stock was hurt. Natalia, thank you so much. Natalia Konejevic, she is, of course, covering some of the stocks on the move for us right here at Bloomberg. You can subscribe to our 5-minute episodes, Stock Movers. Find it on Apple, Spotify, or anywhere you get your podcasts.
That's going to do it for Bloomberg Business
done.
Week Daily. We are done. Balance of Power starts right now.
From Bloomberg's Washington, D.C. studios to our TV and radio audiences worldwide, welcome to Balance of Power. Alongside Joe Matthew, I'm Kaylee Lyons. We're coming to you tonight with some breaking news. The Supreme Court ruling just a few moments ago that it will allow President Trump to oust an official of the National Labor Relations Board and from the U.S. Merit Systems Protection Board for now, while a legal fight goes forward.
The court saying the president, quote, may remove without cause executive officers